Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, Wall Street, it kind of feels like this exclusive private club, right? It's all complex charts, jargon that makes your head spin, and experts who look like they're playing a totally different game than the rest of us. But what if I told you that the biggest advantage in investing, it isn't some fancy degree or a supercomputer? What if it's actually you? Well, today we're going to dive into the brilliant, down-to-earth wisdom of the legendary investor Peter Lynch. We're going to uncover the powerful, untapped edge that you have over the pros. All right, so here's our game plan. First, we're going to completely dismantle that myth of Wall Street expertise. Then we'll uncover the hidden edge that you already have. I'm going to show you Lynch's super simple toolkit for finding amazing companies. We'll talk about why patience is your absolute secret weapon. And then we'll wrap it all up by showing you exactly why being an outsider is your single greatest strength. So let's kick things off with the Wall Street myth. You can picture it, can't you? Marble lobbies, those high-security elevators, conference rooms where these financial wizards make all the big decisions. Look, it's all designed to be intimidating, to make you feel like you just don't belong. The message is loud and clear. Leave this to the professionals. But Peter Lynch says that this very world, it creates a massive, massive blind spot. This right here really gets to the core of it. On one side, you've got Wall Street's game. It's played on screens, totally driven by abstract data and this insane pressure to perform every single quarter. It's detached. But on the other side, you've got Lynch's game. And that game is played in the real world. It's played at your local mall when you notice which stores are absolutely packed. It's about asking simple questions about a product you just love. It's about finding a company with a great story that's going to unfold over years, not just the next 3 months. And this stat really drives the point home. The professionals' fancy tools, they're not the secret sauce. The source material points out that big firms like Merrill Lynch offer these incredibly powerful stock screening tools to all their clients. And guess what? Almost nobody uses them. We're talking less than 5%. That tells you the real edge isn't buried in a data terminal. It's somewhere else entirely. And here's the key takeaway from that. Lynch saw that these professionals were becoming more and more disconnected. They spend way more time in meetings, defending their ideas to committees, selling their picks, than they do actually getting out and researching companies in the real world. They become what he called out-of-touch experts. And that disconnect, well, that creates a huge opportunity for the rest of us. Okay, so if the pros are out of touch, that opens up a massive opportunity, right? This brings us to the very heart of this whole idea, your hidden edge. We're about to completely flip the script and show you how your normal, everyday life is an absolute goldmine of investment ideas that the so-called experts are missing completely. So you might be thinking, come on, really? Well, let's put this idea to the test with an amazing true story. Peter Lynch heard about this investment club at a school called St. Agnes in Massachusetts that was getting unbelievable results. He was so intrigued that he invited the entire class, a bunch of 7th graders, to Fidelity's executive dining room for a pizza lunch, just to find out their secret. So their teacher, a Miss Morrissey, she laid out their strategy, and it was just brilliantly simple. Rule number 1, invest only in what you know. Before they could buy a stock for their pretend portfolio, they had to stand up in front of the entire class and explain exactly what the company did. No jargon, just a simple explanation a kid could understand. So what did they invest in? Things they saw every single day. The popular Pentek pens they all used in class, the Nike shoes all their friends were wearing, and the brands they saw their parents using, like Texaco. Now, the results of this were just fascinating. Their portfolio was loaded with winners that came directly from their own observations. But their one big loser, their one real clunker, was IBM. And here's the kicker. At that time, IBM was the absolute darling stock of professional fund managers. And why? Because it was a safe choice. See, no fund manager ever got fired for losing money on IBM. The kids' only mistake was when they tried to think like a professional. And the results? Well, they speak for themselves, don't they? The St. Agnes portfolio returned an incredible 69.6% over 2 years. They completely crushed the market averages. A group of 13-year-olds, using nothing more than what they saw around them and a few simple rules, totally outsmarted the experts on Wall Street. That, my friends, is the amateur's edge in action. Okay, so the St. Agnes story proves that it can be done. Now, let's get into the nitty-gritty of how you can do it too. Lynch gives us a really simple but powerful toolkit to turn your own real-world observations into a solid investment plan. It all starts with something Lynch calls the 2-minute drill. And he wasn't kidding. He actually used a kitchen timer in his meetings. The rule is this: If you're gonna invest in a company, you should be able to explain why in plain English in under 2 minutes so that a fifth grader could get it. What does the company do? Why is it a good investment? What's the story here? If you can't do that, you don't really understand it, and you shouldn't own it, period. Okay, the next tool in the kit is what Lynch calls legwork. And honestly, this is the fun part. It's research, yeah, but it's not about staring at a spreadsheet until your eyes glaze over. It's about getting out into the world. It's noticing those long lines at a new restaurant. It's trying a new product and just being blown away by how good it is. It's the real world, hands-on proof that the story you told in your 2-minute drill is actually happening. I mean, just take Lynch's own experience with a restaurant called Cracker Barrel. To do his legwork, he didn't call up some analyst in a New York office. No, he got in his car and drove nearly 100 miles through Atlanta rush hour, a 3-hour trip, just that he could have dinner there himself. He was impressed by the whole thing, and that stock became a massive, massive winner for him. That's what legwork is all about. So you found a great company, you totally get its story, and you've done the legwork. Now comes the hardest part. And it is, without a doubt, the single most important part of being successful. It's not about being the smartest person in the room. It's about having the right temperament. It all comes down to patience. All right, let's be real. The stock market is a roller coaster. One of the St. Agnes students actually remembered Lynch teaching them this. Over a 70-year stretch, the market had 40 big declines. You do the math, that's a drop on average every couple of years. So here's the thing. They're normal. You have to expect them. The real trick is not letting them scare you into selling a great company. Your stomach, believe me, is a much bigger threat to your money than your brain ever will be. And this is the reward for that patience. Back in 1957, a group of 88 people in Salisbury, North Carolina, each invested about $1,000 in their local grocery store, a little company called Food Line. They just watched it grow. They held on through all the market's ups and downs. By 1990, that original $1,000 investment had turned into $14 million. That is the life-changing power of finding a great story and just having the patience to let it play out. And hey, if you think this is easy, think again. Even Peter Lynch, one of the greatest investors of all time, admits to what he calls seller's remorse. He looks back and sees these incredible companies like Federal Express and Toys R Us that he sold way too early, missing out on the biggest part of the gains. Patience is a skill, and it's one that even the best of the best have to constantly work on. Okay, let's bring this all home. Let's really summarize exactly why your position as an amateur, an individual investor, an outsider actually gives you a structural advantage over the professionals who are paid to do this full time. So it really boils down to one word: freedom. A professional fund manager, they often have to get their best ideas approved by a committee. They might be stuck buying only from an approved list of stocks, and they're judged every single quarter, which forces them to think short term. You, on the other hand, you answer to no one but yourself. You can buy some great little company nobody's ever heard of. You can ignore all the noise and focus on the 10-year story. You are not forced to buy IBM just because it's safe. And your best information sources? They're literally all around you. Your job gives you an inside look at your entire industry. A simple trip to the mall becomes fundamental analysis. You know, Lynch talks about how his own daughters tipped him off to the Body Shop because they and all their friends loved it. The alert shopper, the observant employee, the engaged parent, every single one of them has the chance to get the message long before it ever shows up in some analyst's report on Wall Street. But listen, here is the final essential piece of advice. A great idea you get from your everyday life, that's just the starting point. The St. Agnes students didn't just notice popular pens, they researched Pentech and discovered it had no debt. Lynch didn't just like the catfish at Cracker Barrel, he checked out the company's story. That crucial second step, that simple 2-minute drill research, is what turns a hunch into a real investment. It's the step most people skip. Don't be one of them. So as we wrap this up, I want to leave you with this one question. I want you to forget the stock tickers and the financial news for just a minute. Just think about your day, the coffee you bought this morning, the software you used at work, that store you popped into on the way home. What great company story unfolded right in front of your eyes today? Because the answer just might be your next great investment. You know, sometimes you hear a story that sounds like it was ripped straight from a Hollywood script. It's one of those classic David versus Goliath tales, but this one is set right in the heart of the financial world. Now, the Goliaths, they're the titans of Wall Street, the best of the best. And the Davids, well, they're a group of 7th graders who decided to take them on. Yeah, you heard that right. Let's get into it. I mean, it's a pretty wild question, isn't it? Can a bunch of kids who are probably more worried about homework and middle school dances actually outsmart the supposed best and brightest minds on Wall Street? It sounds like total fiction, but believe it or not, the answer we're about to uncover is a resounding yes. Okay, so to really appreciate what these kids accomplished, we first have to understand the battlefield they walked onto. And that battlefield is a world where picking your own stocks has become, for most people, a dying art. And this really tells the whole story. Year after year, fewer and fewer regular people are picking their own stocks. They're just giving up. They're taking their money, they're fleeing to mutual funds, and they're basically handing over control of their financial future. The big question is, why? Why is everyone running for the exits? Well, it's because the average person, folks like us, feels completely outgunned. Just look at the other side of this equation. You've got the so-called Wall Street geniuses with their fancy MBAs, their expensive raincoats, and these high-tech computer screens that spit out data all day long. It's an incredibly intimidating picture. Who wouldn't feel outmatched? But here's the funny thing about that myth of the Wall Street genius. The reality is, well, it's not so genius after all. Look at this. A staggering 75%, that's 3 out of every 4 professionally managed mutual funds, fail to beat the simple stock market averages. It turns out, even for the experts, this game is incredibly hard to win. And that really gets to the heart of the problem, doesn't it? For people who are used to succeeding in life, getting A's in school, getting that promotion at work, the stock market can be a brutally humbling place. It's one of the few arenas where you can do everything right and still lose money, still feel like you failed. And after a while, a lot of people just get tired of getting that F, and they walk away for good. But against this backdrop of fear and complexity, something absolutely amazing happened. An incredible story unfolded in what has to be the most unlikely of places, a 7th grade social studies class at the St. Agnes School. And this chart, wow, this chart says it all. Over a 2-year period, the portfolio these 7th graders put together gained an incredible 70%. Now, to put that in perspective, the S&P 500, the benchmark for the entire market, was up just 26%. They didn't just beat the pros, they absolutely crushed them, left them in the dust. Just let that number really sink in for a second. Their performance was better than 99% of all professional equity mutual funds. A group of kids with zero formal training beat nearly every single highly paid expert in the entire country. How on earth did they manage to do that? Well, their secret wasn't some complex algorithm or any kind of secret insider information. Nope. It was a strategy so beautifully simple, so common sense, you could literally draw it with a crayon. This was their guiding principle, a famous piece of wisdom from the legendary investor Peter Lynch. And the idea is just profound in its simplicity. If you don't understand a company well enough to explain what it does in simple terms, like crayon simple terms, then you have no business putting your hard-earned money into it. And here's exactly how they put that principle into practice. Their process was incredibly disciplined, and it mirrored what the pros do, but with one huge game-changing difference. After listing some companies and doing the basic research, they got to the most important step of all: understand. Before they could even think about buying a stock, a student had to stand up in front of the whole class and explain, in simple language, exactly what that company did. And if they couldn't do it, the stock was immediately off the list. End of story. So what it all boils down to is this one incredibly powerful idea: buy what you know. They use their own everyday experience as kids and as consumers to spot world-class investment opportunities that the so-called pros on Wall Street were completely overlooking. So, how did this buy what you know strategy actually play out? Let's take a look at the specific companies they picked. Let's see how their unique, kid's eye view of the world gave them this powerful investing edge. I mean, just look at their portfolio. It reads less like a Wall Street report and more like a teenager's shopping list. And that was precisely the point. They invested in The Gap, because that's where they all bought their jeans. Nike, because they all wore the shoes. Pepsi, Disney, Topps trading cards. See, these weren't just ticker symbols on a screen to them. They were companies whose products they actually used, understood, and in many cases, loved. And it really doesn't get any simpler or more powerful than this. This quote from a student named Steve was his entire investment thesis for buying Nike stock. No spreadsheets, no financial jargon, just a simple, brilliant observation from a loyal customer. He knew it was a great product, so he figured, why not invest in the company that makes it? It's genius. And through this whole process, they developed some incredibly sharp insights. They called it their St. Agnes chorus of rules. Things like always do your homework, look for companies with room to grow, and maybe the most important one, never fall in love with the stock. They even figured out that out of 5 picks, you're really just looking for one big winner to carry the portfolio. Honestly, this is the kind of wisdom that many professional investors spend decades and millions of dollars trying to learn. Now, I know what you might be thinking. Okay, great story, but it was probably just a fluke, right? A lucky break for a group of kids. Well, it'd be easy to dismiss it that way. But the lessons from St. Agnes aren't just for 7th graders. They are part of a powerful, replicable model for success that anyone, and I mean anyone, can use. And the proof is right here. Take a look at the National Association of Investors Corporation, or the NAIC. This group represents thousands of investment clubs made up of regular, everyday people. And just look at their record. Year after year, the majority of these clubs beat the S&P 500. And they do it using a disciplined, common-sense approach that's almost identical to the one the kids at St. Agnes used. This stuff works. Their success, and the success of the NIC clubs, is built on a few core truths. So let's start with the first and most incredible power of all, time. Let's say you would put just $1,000 into the stock market back in 1940, and you just left it alone. You didn't touch it. 52 years later, it would have grown to over $333,000. Not bad at all, but just watch what happens next. Okay, but now let's add a second layer, the power of consistency. What if, on top of that initial $1,000, you added another $1,000 each and every year? Your total investment out of your own pocket would be just $52,000, but that amount would have ballooned into more than $3.5 million. That is the magic of investing regularly, through good times and bad. And now for the final and maybe the most powerful ingredient of all, courage. What if, on top of your regular investing, you added an extra $1,000 every single time the market got scared and dropped by 10%? That simple act of courage, of buying when everyone else was panicking and running for the exits, would have turned your investment into nearly $6.3 million. So what's the ultimate takeaway here? The kids at St. Agnes prove that the greatest investment edge you can have isn't a fancy degree or a powerful computer. No, it's the knowledge you already possess. It's right there in your own home, in your own life. You interact with fantastic companies every single day. The only question is, are you paying attention? Because one of them might just be your next great investment.
All right, today we are going to dig into a really powerful idea from the legendary investor Peter Lynch. It's something that could totally change how you look at your investments, especially when the news starts to get a little crazy. He has this concept of the weekend worrier. And believe me, it is a trap that has cost people a fortune. So let's get right into it.
You know, we're starting with this quote because it just cuts right to the chase. What Lynch is saying here is that when it comes to investing, things like willpower, discipline, and just keeping your emotions in check, well, they're way more important than being the smartest person in the room. It's your gut reaction, that feeling in your stomach, that will really truly make or break your success.
So what does that really mean for us? It means the biggest threat to your money isn't a recession or some crazy market crash. Nope, it's you. It's us. It's our completely natural human instinct to react with our emotions when we see scary headlines, to panic when things look bad, and to get way too excited when they look good.
Okay, now check this out because this is a fascinating paradox. Over here on the left, you've got the informed worrier. This is the person who reads every article, watches all the news, and tries to time the market, jumping in on good news and selling out of fear. But on the right, you have the disciplined ignorer. This person just invests on a schedule, like clockwork, no matter what's happening. And Lynch's big, surprising point, the disciplined ignorer almost always does better in the long run. Wild, right?
And to prove this isn't just some theory, Lynch tells this fantastic personal story. It's about the Barron's Roundtable. This is an annual meeting of, supposedly, the smartest people in the entire world of finance. And as you're about to see, even these experts are just as human, just as prone to emotional decisions as the rest of us.
So, I want you to picture the scene. We're at the Dow Jones complex in Manhattan, a real center of financial power. Lynch describes this lobby that's as massive and intimidating as St. Peter's in Rome. But once you get inside that conference room, the pressure is just immense. You've got these spotlights blasting 13,000 watts of heat down on you. Photographers are everywhere, snapping close-ups. Microphones are hanging from the ceiling, ready to pick up every single word, every hesitation.
And the funny thing is, this so-called round table, it's not even round. It's this giant triangle. The financial wizards are all lined up on one side, basically getting grilled by the hosts on the other.
And the guy running this whole inquisition is the editor, Alan Abelson. Lynch paints him as the resident wit, a guy who was to finance what Dorothy Parker was to romance, which is to say he was incredibly sharp, cynical, and just hilarious.
Appelson's one-liners were legendary for just cutting through all the financial fluff. For instance, when one of the experts recommended a company that was, just losing money year after year, Appelson just deadpanned, "What else does it have going for it?"
He even got Lynch himself. When Lynch said his favorite stock at the time has a lot to go, Abelson, without missing a beat, shot back in which direction.
And maybe my favorite, when another expert started talking about a multifaceted approach, Abelson quipped, "Please, Mario, this is a family magazine." His humor was just the perfect weapon for popping that bubble of Wall Street's self-importance.
But here's the thing. Underneath all the jokes and the witty banter, a really serious problem started to show up. See, the first half of these big meetings was always about making grand predictions about the economy, the market, the whole shebang. And this, Lynch says, is where everything always started to go wrong.
And this all led to what Lynch named weekend worrying. It's a habit that I think we can all relate to. You spend Saturday and Sunday reading all this awful news, global warming, government deficits, wars, recessions, and by the time Monday morning rolls around, you're so worked up and terrified that you just want to sell everything. Well, it turns out these experts were the absolute masters of weekend worrying.
What these experts were doing was making a classic mistake. They were trying to predict the future by staring into the rearview mirror. They saw the big 1987 crash, for example, and they just assumed that that one event would define everything that happened next in 1988.
And this slide just perfectly shows how incredibly wrong they were. In '88, right after the crash, they predicted a worldwide depression. What happened? The market recovered. In 1990, the pessimism was so bad that Lynch said he heard cab drivers telling people to buy bonds, a classic sign the market has bottomed out. But the real kicker is 1991. During the Gulf War, the panel predicted a market drop of up to 33%. The reality? A 30% gain in the S&P 500. If you had listened to them, you would have missed one of the best market years in decades.
So, if the expert predictions are basically useless, what should we be paying attention to? Well, Lynch says we need to ignore all that daily noise and zoom way out to what he calls the even bigger picture. This is how you build an unbreakable investor mindset.
And the even bigger picture is actually incredibly simple, and that's what makes it so powerful. Over the last 70 years, a time frame packed with wars, recessions, you name it, stocks have returned an average of 11% a year. Bonds and CDs, less than half that. This long-term data is infinitely more valuable than any one person's prediction for next year.
Now, of course, to get that 11% return, you have to endure the bumps in the road. In that same 70-year period, there have been 40 scary declines of 10% or more. That's more than one every couple of years. These aren't rare, they are a regular expected part of investing. And get this, of those 40 declines, 13 of them were terrifying drops of 33% or more. Think about that for a second. Even those really brutal bear markets happen, on average, about once every 5 or 6 years. They are just part of the landscape. So the most important point is this. We have to completely reframe how we think about market downturns. They are not a surprise. They're not a sign that the whole system is broken. They are a normal, recurring event like the seasons changing. It's just what markets do.
To really help us get this idea into our heads, Lynch gives us this absolutely brilliant analogy, and it completely changes your perspective on what to do when the market inevitably takes a dive.
He says a smart investor should have the same attitude toward a market decline that a Minnesotan has toward a blizzard. I mean, if you live in Minnesota, you know winter is coming, right? You don't panic and sell your house every November. No, you put on a parka, you throw some salt on the driveway, and you remind yourself that eventually summer will come back. The disciplined investor does the exact same thing. They know declines are coming, they ride them out, and they see them for what they are, a chance to buy great companies on sale. So really, it all just boils down to this simple 3-step playbook. First, expect declines. Don't be surprised by them. They are not an if, they are a when. Second, when they do happen,
Stay invested. Do not let your gut reaction, your weekend worrying, trick you into selling at the absolute worst time. And third, if you can, see the decline as a bargain sale and buy more.
And that really just leaves us with one final question. Because the next 10, 20, or 30% decline, it's coming. The headlines are going to be terrifying, and I guarantee you a room full of experts will be on TV predicting the end of the world as we know it. The only thing that matters is, what are you going to do?
All right, let's dive right in. Today, we're getting inside the head of a true Wall Street legend, Peter Lynch. We're going to use his classic book, Beating the Street, to build a straightforward, no-nonsense guide for your investment portfolio. You know, if you've ever felt completely overwhelmed by all the financial advice out there, this one is for you. Let's get to it. So what's the huge problem we're trying to solve here? Well, it all starts with this one number. When Peter Lynch wrote his book, this is how many mutual funds were out there for investors. 3,565. And believe me, that number has only exploded since then. The whole point of mutual funds was to make investing simpler, right? But instead, they just created this gigantic, confusing universe of choices.
And this isn't just my opinion. Lynch himself laid it out perfectly. The number of funds is bigger than all the individual stocks on the major exchanges combined. Think about that for a second. It really is a jungle out there for the average person. So how in the world are you supposed to find your way through it? Well, turns out Lynch has a map.
So here's our game plan. First, we're going to navigate that mutual fund maze. Then we'll hit the single biggest decision you have to make, stocks versus bonds. After that, we'll dig into Lynch's pretty radical all-stock income strategy, give you a guide to the different fund types, and then show you how to build your very own all-star team. And we'll wrap it all up with Peter's most important roles.
Okay, first up, the mutual fund maze. Like we just saw, the sheer number of options is just staggering. You've got country funds, sector funds, value funds, growth funds. The list goes on. And it's exactly this kind of complexity that makes having a clear, simple framework not just nice to have, but absolutely essential.
And that brings us right to the big one. Section 2, stocks versus bonds. According to Lynch, there is no decision that will have a bigger impact on your future wealth than this one. You know, the old conventional wisdom says young folks should buy stocks for growth, and older people nearing retirement should buy bonds for income. But Lynch, he argues that whole way of thinking is completely obsolete.
You know, the fundamental difference really boils down to this. When you own a stock, you own a tiny piece of an actual company. You get to share in its success. And as that company grows, the dividends it pays you can grow too. A bond, though, it's just a loan. You're lending them money. You get a fixed interest rate, which is fine, but you never get a piece of the action when the company hits a home run. That interest payment on a bond will never, ever go up.
And the numbers? Well, the numbers don't lie. They make the case crystal clear. Over a 70-year stretch, stocks delivered an average return of over 10% a year. Long-term government bonds, they didn't even hit 5%. Over a long period of time, that difference is absolutely massive. This isn't just an opinion. This is the market's long-term track record.
So let's make this real. Let's crunch the numbers with an example from Lynch himself. Look what happens to 10 grand over 20 years. If you go 100% bonds, sure, you get a decent $14,000 in income. But your original investment? It's still just $10,000. Now, look at the 100% stock portfolio. You get almost the same amount of income, but your final value has ballooned to over $46,000. It's not even a contest. You end up 4.5 times richer.
And this leads us to what I think is the most powerful part of Lynch's entire argument, the all-stock income plan. What if, and stick with me here, what if you could get a steady, reliable income stream without owning a single bond? I know, it sounds a little crazy, but as you're about to see, the math is actually pretty simple.
Let's put a real number on it. Let's say you've got a $100,000 nest egg, and you need $7,000 a year to help with the bills. Now, the old advice, the stuff your grandpa heard, would be screaming, buy bonds. You need that safe income. But Lynch asks us to think differently. Can we pull this off with just stocks?
Here's exactly how it works. In year one, your $100,000 portfolio pays about a 3% dividend. That's $3,000 right there. To get the other $4,000 you need, you just sell that amount of stock. But here is the magic part. Your portfolio is also growing. Assuming it grows at a historical rate of 8%, it would grow to $108,000. So even after you sell $4,000, you're left with $104,000 at the end of the year. Your money is actually growing, not shrinking. And over time, as your portfolio gets bigger, your dividends increase, meaning you have to sell less and less stock to hit your goal.
So what's the end result? After 20 years of taking money out every single year, that initial $100,000 has grown to almost $350,000. You've more than tripled your wealth while living off it at the same time. I mean, that is the incredible power of prioritizing growth over fixed income.
But of course, I know what you're thinking. There's always a catch, right? It's that little voice in the back of your head, the fear factor. What if the market crashes the day after I invest all my money? This is the single biggest reason people play it safe and stick with those low-performing bonds, even when all the data says not to.
Well, Lynch actually ran the numbers on that exact nightmare scenario. Let's say the market absolutely tanks, drops 25% the day after you invest. Yeah, you'd feel awful, but if you just hang on and do nothing, 20 years later, your all-stock portfolio would still be worth about $185,000. That's nearly double what you would have had if you'd just stuck with a $100,000 bond. The long-term power of growth is just that resilient.
So if we're convinced that stocks are the way to go, how on earth do we pick the right funds? And that brings us to Section 4, a guide to fund types. The huge insight from Lynch here is that you shouldn't just be chasing last year's top performer. What really truly matters is understanding a fund's style, its category. He basically breaks the whole universe down into 5 main types. You've got capital appreciation funds. These are your aggressive gunslingers. Then there are value funds, which are always hunting for a bargain. Quality growth focuses on those steady, blue-chip giants. Emerging growth, that's all about small, fast-growing companies. And then you have special situations, which invest in unique turnaround stories. Knowing the difference here is everything.
And that leads us perfectly into Section 5, build your all-star team. So how do we actually use these different fund types? Well, Lynch says you don't try to pick the one single winner. No, instead, you assemble a team of different funds. That way, you pretty much guarantee you'll have something invested in the right place at the right time. And his game plan is beautifully simple. Just divide your money among different fund types. You could have one from each of those 5 main categories we just talked about, and then maybe add a 6th more conservative fund like a utility fund to act as a sort of safety net in a rough market. This creates a really robust, diversified portfolio that isn't just betting on one style to do well.
All right, let's bring it all home with our final section, number 6, Peter's Key Principles. Think of these as the core rules, the simple truths you need to take with you that will cut through all the noise and confusion out there.
Oh, I love this one. There's no point paying Yo-Yo Ma to play a radio. It's brilliant. What he's saying here is, why would you pay a high-priced fund manager a big fee to simply buy government bonds, something you can do yourself directly from the government for free? It's the perfect analogy for not overpaying for something that's really simple.
This might be his most important warning of all. Chasing last year's hottest fund is a trap, and so many people fall into it. That fund usually just got lucky with one hot sector, and it's just as likely to be at the bottom of the list next year. Stick with managers and funds that have a solid, consistent, long-term track record. Don't chase fads.
So, to wrap up the entire Peter Lynch playbook, first, lean into stock funds. Put as much as you can in them for long-term growth. Second, know the style of fund you own, not just its performance last week. Third, diversify across a few of those different styles. Fourth, when you have new money to invest, think about putting it into the fund types that have been lagging a bit lately. And finally, stick with solid, consistent long-term performers.
And that really brings us to the final thought. The whole idea here is a big shift in perspective. It's not about trying to find the one best fund. It's about understanding the different roles different funds can play and then building a solid team. So the question I want to leave you with is this. Now that you know a fund style is way more important than its short-term performance, how does that change the way you look at your own investments?
You know, when you hear the name Peter Lynch, you probably think of a Wall Street titan, right? The guy who grew the Magellan Fund from this tiny little portfolio into a $14 billion behemoth. But every legend has an origin story, and Lynch's is not what you'd call glamorous. It's a story of being handed a forgotten fund in a market that everyone had completely given up on, and then using that obscurity to build one of the greatest track records in history. So let's dig into how he pulled it off. And this quote, man, it really is the key to this whole story. Lynch himself believed his greatest advantage was that for years, absolutely nobody was paying attention to him. This gave him the space to learn, to make mistakes, and to perfect his very unique style far, far away from the spotlight of Wall Street. That blessing in disguise, it was the secret ingredient to everything that came next. All right, so to really get what Lynch achieved, we have to paint a picture of the world he was stepping into. Forget the booming markets we've seen in recent decades. This was a totally different beast. And frankly, it was a miserable environment for any investor. The market was in what Lynch himself called the doldrums. After the massive collapse of 72 to 74, people were just fleeing stocks in droves. I mean, the fund salesmen who used to go door to door, they were back selling vacuum cleaners. That's how bad it was. Investing in stocks was deeply, deeply unpopular. And this was the exact moment Peter Lynch gets asked to manage a fund. And the Magellan Fund itself? Oh, it was a total casualty of all this apathy. Just look at this decline. It started out as a respectable $20 million fund, but over a decade, a steady stream of customers just pulling their money out. It was hemorrhaging cash. By 1976, it was down to just $6 million. At that size, the management fees were barely enough to keep the lights on. It was on life support. So, in what I guess you'd call an act of corporate desperation, Fidelity decides to mash two of its struggling funds together just to save on costs. They took the tiny Magellan Fund and combined it with the Essex Fund, which had its own set of problems, but came with one huge perk, a $50 million tax loss carry forward. What does that mean? It means the new combined fund wouldn't have to pay a dime in taxes on its first $50 million in gains. It was a marriage of convenience between two Wall Street cast-offs. And this is what Peter Lynch inherited in 1977. Not a powerhouse, not some rising star, but this $18 million Frankenstein's monster of a fund that nobody wanted in a market nobody liked, with a handful of skittish customers who were leaving as fast as they possibly could. This is ground zero. Now, you'd think, faced with this mess, a typical manager would have some grand top-down strategy, right? But Lynch, he was anything but typical. His approach was personal. It was empirical, and boy, was it relentless. He developed what you can only really call his bloodhound style. He said it himself, right there. There was no master plan. He didn't care if he was overweighted in broadcasting or underweighted in energy. He was just following the scent of a good story. He was on the hunt for compelling companies one by one, letting the details of the business guide him, not some grand theory about the market. So what exactly is bloodhound investing? Well, it's all about being flexible. It's this idea that you can find an undervalued gem literally anywhere. One day it might be a major oil company, the next it might be a funeral home chain. You don't box yourself in, you follow the scent of value, wherever it takes you. And this chart, wow, it just brilliantly shows how all over the place his approach was. I mean, look at this portfolio. What on earth do vinyl flooring, tacos, women's pantyhose, funeral homes, and naval shipyards have in common? The answer? Absolutely nothing, except that Peter Lynch had found a compelling story in each and every one. He bought Congolian because they had this new seamless flooring product. He bought Service Corporation International because it was basically becoming the McDonald's of funeral homes. Each one was a unique scent he followed. His information edge didn't come from some complex algorithm. It was coming from the real world. His wife, Carolyn's enthusiasm for Hanes Legs pantyhose, that was a buy signal. Meanwhile, he tells his Wall Street trader to buy Taco Bell, and the guy's like, is that the Mexican telephone company? I mean, come on. It just says it all, right? Lynch was paying attention to Main Street, while Wall Street was completely out of touch. But you know, being a bloodhound doesn't mean you're perfect. Not by a long shot. In fact, some of Lynch's most critical lessons came not from his wins, but from his massive, painful mistakes. These were the errors that really shaped him as an investor. Okay, first a classic win. He heard about this place, Cracker Barrel, but he doesn't just read a report. No. He flies to Atlanta for a conference, rents a car, and drives what he thought was a few miles, which turned out to be 100 miles, just to eat dinner there. He was so impressed by the food, by the whole operation, that he invested. It became a 50-bagger for the fund. Now that's on-the-ground research. But then, oh boy, there's the one that got away. On that very same trip to Atlanta, he visited this new do-it-yourself store called Home Depot. He saw the potential, he was impressed, and he bought the stock at just 25 cents a share. But then, as he put it, he just lost interest and sold it about a year later. That stock, that little stock he bought for 25 cents, went on to be a 260-bagger. He called it one of the 2 worst sell orders of his entire career. And that painful experience led to one of his most powerful lessons, summed up right here in this famous phrase. He realized he was selling his big winners, the flowers like Home Depot, to go chase after other, less promising stocks, the weeds. It's a classic investor mistake, and learning to just hold on to his winners was one of the most profitable lessons of his early years. So Lynch learned his edge came from just doing the legwork. He knew he could not guess the market, but he figured he could out-research it. And that's exactly what he did. He built a systematic process for gathering information that became the real engine of his success at Magellan. His method was pretty simple, but man, was it relentless. At Fidelity, they started this policy of taking corporations to breakfast, lunch, and dinner. Lynch made a point to meet with companies he wasn't invested in just to see what he was missing. He made sure to talk to someone from every major industry at least once a month. But all this work, it was all building up to his single most powerful information gathering tool. And here it is. This was his masterstroke. At the end of every single meeting, he'd ask this simple question. He found that when a CEO or a manager candidly admits that a rival is just crushing it, that's the most powerful, honest-to-God endorsement you can ever get. He often said he'd go right out and buy the competitor's stock based on that answer alone. So, with this intense, story-driven, research-heavy process, Lynch starts putting up these just incredible numbers. But here's the crazy part, the real paradox of his early years. Even as he was generating legendary returns, investors were still running for the exits. I mean, the results just speak for themselves, right? Look at 1980. The Magellan Fund is up almost 70%. The S&P 500, a benchmark for the overall market, was up 32%. He wasn't just beating the market, he was absolutely demolishing it. His strange, eclectic method was working spectacularly. But here is the absolutely wild part. Even with these incredible results, for 4 straight years, people kept pulling their money out. He says that in this period, a full 1/3 of the fund's shares were redeemed. Why? Well, his guess was it was old investors from that Essex fund merger who just wanted their money back now that they'd broken even. The result? He was constantly being forced to sell his best stocks, his winners, just to pay back the people who were leaving. The tide really started to turn around 1981. Another merger, this time with the Salem Fund, brought in some more assets. And then, the big one. After 4 years of being closed off, Magellan was finally reopened to the public. New money could finally come pouring in. The fund quickly crossed the $100 million mark, and the era of obscurity was officially over. You know, looking back, Lynch had a really simple explanation for his incredible start. It wasn't just that he was a genius, it was the opportunity itself. He was operating in a market so beaten down and pessimistic that you could buy great, growing companies for 3 to 6 times their annual earnings. It was the bargain of a lifetime, and he was one of the few bloodhounds out there actually sniffing around for a deal. And this, I think, brings us to the final, and maybe the most important takeaway for all of us. Lynch's success was built on turning off the noise of the market and focusing on the tangible story of an individual business. He did his own research, trusted his own eyes, and ignored what everyone else was saying. So the real question for us is, in today's world of endless data, 24/7 news cycles, and social media hype, how can we do the same thing? How can we find the real story? Peter Lynch. You hear that name and you just think, legend, one of the greatest to ever do it. But here's the thing about his success. It wasn't some black box algorithm or a secret formula he kept locked away. Nope. It was something way more impressive and, frankly, more relatable. It was an absolutely relentless work ethic combined with the mind of a master detective, always hunting for that next great story. So let's pull back the curtain and really get inside the playbook that let him conquer Wall Street. First things first, you have to understand the guy's routine. There was no magic here, not at all. It was just an unbelievable amount of what he called sweat equity. I mean, his day started long before the opening bell, and it was all built on a foundation of pure, old-fashioned hard work. I want you to just picture this for a second. It's 6:05 in the morning. It is pitch black outside. Peter Lynch is in the back of a car heading into Boston. Now, up front, his buddies, they're radiologists, and they're looking at x-rays with a special light. But in the back, Lynch has his own little light on, and he's already neck-deep in annual reports. The rest of the world is still asleep, and this guy is already deep into his research. That's the level we're talking about. Now check this out. You'd think a guy managing billions would have some kind of NASA-level command center, right? Well, take a look at his sophisticated tools. We're talking standard S&P guides, a Rolodex, an antique even then, yellow legal pads, and a calculator you could probably find at a garage sale. He even had one of the first Quotron machines, but he preferred the one with a blank screen. Why? He said the newer ones that showed live stock prices were just too exciting and a distraction. It was all about focusing on the fundamentals, not the noise. So by 6:45, he's at his desk. And that hour and 15 minutes before the market even thinks about opening, he was an absolute machine. He'd go through everything the other Fidelity managers were buying and selling, he'd read all the in-house analyst reports, and then he'd just devour the Wall Street Journal. And all of this was just to get a final list of orders ready for his trader by 8 a.m. sharp. I mean, think about that. He did a full day's worth of analysis before most of us have even finished our first coffee. And this quote, this gets to the absolute heart of his entire philosophy. Lynch figured out pretty early on that sitting there, watching the little stock ticker go up and down, was a complete and utter waste of his time. He calculated that an extra 50 minutes he spent watching the screen could have been used to call 2 more companies. So the lesson is simple, but it's so powerful. Forget the stock, focus on the business. What is the story? That's where you find the real edge. So how did he keep all these companies' stories straight? Not with some fancy database. Nope, he used a simple, powerful tool, a notebook. After every single call, every meeting, he'd just jot down the company name, the stock price, and then a 1 or 2 line summary of the story. Just a quick sentence to remind himself, why did I buy this thing in the first place? That notebook was his memory, his anchor, making sure he never lost the plot on an investment. But here's the thing, Lynch's success wasn't just about him grinding it out alone. He wasn't working in a vacuum. He was a key part of this unique system at Fidelity that was like a massive force multiplier for all his hard work. You could call it their secret weapon, a culture of pure accountability that was, frankly, revolutionary. This slide just lays it out perfectly. Look, in the traditional model on the left, an analyst recommends a stock, the fund manager buys it, and if it tanks, well, the manager just points a finger at the analyst. It's a total pass-the-buck system. But Fidelity? They flipped that script completely. Fund managers like Lynch had to do their own homework. The analysts were there to help, to provide another perspective. But at the end of the day, the fund manager owned the decision, 100%. It created this incredible culture of ownership. And this is where it gets really smart and kind of counterintuitive. Lynch was a huge proponent of Fidelity launching more funds. Now, that sounds crazy, right? Why would you want more internal competition? But he saw the genius in it. See, every new fund meant a new manager, and every new manager was another fact gatherer, another snoop, as he called them, out there digging into some new corner of the market. It created this massive collaborative intelligence network where everyone was constantly sharing their best ideas. It literally made the entire company smarter. Okay, so we've got the foundation, an unbelievable work ethic, and a brilliant system. But what were the actual day-to-day rules Lynch lived by? Let's dive into the practical principles that really defined his stock picker's playbook. 90 seconds. That's it. That's all you got. So what's this about? Well, this was the hard and fast time limit Lynch put on anyone pitching a stock in Fidelity's internal meetings. And the whole reason for that 90-second rule was this core belief. He was absolutely convinced that if you truly understand why you're investing in a company, you can explain it quickly and simply. This wasn't about dumbing things down. It was the ultimate test of clarity. If you were rambling on, using a bunch of jargon, well, that was a huge red flag that you probably didn't understand it well enough yourself. And here's another wild rule from those meetings that just sounds bizarre at first. After you gave your 90-second pitch, nobody was allowed to give you any feedback. No criticism, no debate, nothing. Why on earth would they do that? Well, Lynch knew that a course of criticism, especially for a contrarian idea, could absolutely crush a manager's confidence. This rule was designed to protect conviction, to stop someone from selling a potentially brilliant idea way too early just because they got ridiculed in a meeting. And that brings us to the ultimate case study. This is where all of these principles, the hard work, the independent research, the unwavering conviction, they all came together in one of the greatest, most gutsy contrarian bets in modern history, the Chrysler turnaround. You have to understand the environment here. Early 1982 was not just a bad market. It was a time of absolute crippling fear. You had double-digit inflation, sky-high unemployment. The whole mood was so bleak, Lynch said people were literally stocking up on canned goods, buying gold, and even shotguns. They were getting ready for a total societal collapse. And that was the backdrop for his biggest bet ever. So this is where Lynch the detective really goes to work. He actually starts by looking at Ford, but his research keeps pointing him towards Chrysler, which is trading for just $2 a share. Everybody assumed it was dead, headed for bankruptcy, but Lynch did the work. He dug into the balance sheet and found the crucial clue. Chrysler had over $1 billion in cash. They weren't going bankrupt anytime soon. That led to a meeting with the legendary Lee Iacocca, which turned into a 7-hour marathon that convinced him of their secret weapon, the minivan. By July, he was all in, buying the absolute maximum 5% of his fund that the law allowed. This is what real conviction looks like. He's making this enormous bet, and almost everyone around him, his friends, his colleagues, the so-called experts, they're all telling him he's completely insane. He just had to block out all that noise and trust his own research. And of course, the rest is history. That single bet became a cornerstone of his legendary performance. So what's the big lesson here? What's the core mindset that ties all of this together? How did Lynch not just survive, but actually thrive in moments of absolute market panic, like the one that led him to Chrysler? Well, he wasn't just a blind, stocks are always good kind of guy. He was a pragmatist. He had clear, simple rules for when to play defense. This one, his 8th principle, is a perfect example. See, back in that fearful time in 1982, Treasury bonds were yielding 13–14%. For Lynch, the math was just a no-brainer. If the government is going to hand you a return that high, risk-free, you take it. It was a rare moment when bonds were simply the smarter play. But this right here, this quote is the very heart and soul of the Peter Lynch philosophy. For a true stock picker, a market crash is not a disaster. It is a gift. It's a Black Friday sale. It is the single greatest opportunity you will ever have to buy fantastic companies at ridiculously cheap prices. He literally said he'd get happy when the market dropped a few hundred points because it meant bargains were being created. Fear is your enemy. Opportunity is the reward for those who've done their homework. So all of this leaves us with one final thought, one final question. The lessons from Peter Lynch's playbook aren't just history. They are preparation. Because we all know another panic is coming. Another moment of intense, widespread fear is inevitable. The only question is, when it hits, will you be selling with the crowd? Or will you have your notebook ready, hunting for the next great story?
All right, today we're going to unpack one of the greatest and, frankly, most counterintuitive investing stories ever told. We're talking about Peter Lynch and how, at the helm of the Fidelity Magellan Fund, he took a portfolio with over 1,000 stocks and somehow managed to absolutely demolish the market averages. It's a story that really, it just defies all the conventional wisdom you hear on Wall Street.
Okay, so let's just start right here, because this quote from Lynch himself, it perfectly captures the problem he was facing. By the early 1980s, his fund, Magellan, had gotten so massive and he owned so many stocks that all the critics were saying it was impossible for him to do anything but just mirror the market. They were basically accusing him of running a glorified index fund and just charging people high fees for it.
Right. That is the big question, isn't it? I mean, how on earth do you take a portfolio that, on the surface, looks like the entire market and then use it to beat the entire market? And not just for a year, but year after year. Well, that's exactly what we're going to break down.
So here's how we're going to do it. First, we're going to tackle that myth that his fund was just too big to win. Then we'll get into his totally unique way of finding amazing investment ideas. After that, we'll see how he backed those ideas with huge conviction-led bets, how he navigated the insane 1987 crash, and finally, we'll pull it all together and distill the timeless principles that made all of this possible.
Okay, so let's start with that first massive hurdle. By 1983, Wall Street was pretty much convinced that Magellan's size had become its biggest weakness. The fund was just growing at a pace that seemed completely and utterly unmanageable.
I mean, just look at these numbers. The growth was absolutely staggering. In just a few months, the number of stocks in the portfolio doubled, and the assets, they ballooned to $1.6 billion. So you can see why the critics were circling, right? Their argument was pretty simple. With that many stocks, how could he be anything but the market? How could he possibly find an edge?
But this is where Lynch's genius comes in. He had this brilliant counter-argument, and it's captured in his 9th principle. He argued that, yeah, you could own 1,000 stocks, but if they were 1,000 unusual stocks that weren't in the typical Wall Street portfolio, then your fund would look nothing like the S&P 500. See, it wasn't about the number of stocks, it was about the kind of stocks you owned.
And this right here, this chart, gets to the absolute heart of his strategy.
You look at it and you see 900 stocks, which sounds insane. But look closer. 90% of the money was concentrated in his 200 best ideas. And those other 700 stocks? Well, that was his farm system. Think of them as tiny exploratory bets where he could follow hundreds of different stories and just wait for the next big opportunity to grow into a major holding.
And this is where it gets really clever. You see, those 700 small positions, they weren't just clutter. No, they were his secret weapon for discovery. He had this core belief that great investment ideas were absolutely everywhere, and this huge portfolio was his way of listening to the entire market at once.
And here's a perfect example of his detective work in action. It all started with this tiny position he had in a jewelry company called Jan Bell. He's in a meeting with them, and they happen to mention that their best customers are these new warehouse clubs, and they just can't keep up with the demand. For Lynch, a massive light bulb went off. He thought, wait a minute, if they're selling that much jewelry through these clubs, the club's overall sales must be incredible. So he digs in, finds out Wall Street is completely ignoring these companies, and buys heavily into stocks like Costco. It was an absolute home run.
And his hunt for ideas wasn't just in his backyard. It was global and it was relentless. I mean, the guy was a machine. In 1985, he took this now legendary research trip to Europe. In just 3 weeks, he met with 23 different companies across Sweden, Norway, Germany, and Italy, just digging and digging for bargains that American investors had completely missed.
And just look at what he found. He found Volvo, where the company had so much cash on its balance sheet that its value per share was equal to the stock price. I mean, you were basically getting the entire car manufacturing business for free. He found an insurance company, Scandia, that was guaranteed to double its earnings because of a rate increase, but the local investors hadn't even noticed. He just did the homework, the hard work, that nobody else was willing to do.
But, finding these hidden gems was really only half the battle. The other half was having the guts to bet big when your research gave you that deep conviction. And in the mid-'80s, Lynch's conviction was just laser-focused on one industry in particular.
The auto industry. He saw this massive cyclical rebound coming, and he didn't just dip a toe in the water. No, he dove in head first. The fund made well over $100 million in profit from Ford, another $100 million plus from Chrysler, and almost $80 million from Volvo. And these were not small bets. At certain points, these three companies alone made up 8% of the entire fund.
But this wasn't some blind bet. You see, Lynch hated the idea of just throwing darts. He explained his method this way. Some managers decide, okay, I want 8% of my fund in autos, and then they go pick some stocks. Lynch did the exact opposite. He analyzed each company from the bottom up, found what he thought were the absolute best stories, like Ford and Chrysler, and then he bought them. The fact that they added up to 8% of the fund, that was just a byproduct of his conviction in those specific companies.
And man, do the results speak for themselves. The lazy, easy approach would have led you straight to General Motors, the biggest player in the industry. And hey, GM did okay. It tripled. But Lynch's specific, deeply researched picks, Ford delivered a 17-fold return. And Chrysler was a staggering near 50-bagger. That's the difference that doing your homework makes.
But of course, no great investing career is just a straight line pointing up. Every single strategy gets tested, and for Peter Lynch and the Magellan Fund, the ultimate test, it came on a day that would go down in history.
So let's set the stage. The market was absolutely roaring. By the middle of 1987, Magellan was already up an incredible 39% for the year. Lynch was fully invested, he was riding the wave, and he was actually annoyed that he was lagging behind the S&P 500's 41% gain. Can you believe it? Everything seemed to be going perfectly.
And then the floor just fell out from under everyone. October 19th, 1987. The single worst day in the history of the stock market. It was pure, unadulterated panic and a brutal, brutal test for any fund manager.
Now here's the thing. Lynch had kind of seen this movie before, just on a much smaller scale. Over the years, he'd already identified this clear pattern for his fund. When the broader market went down, his specific collection of stocks tended to go down even more. But when the market recovered, his fund would roar back even faster and go even further. He knew it was a wilder ride, but he also knew it was a ride that ultimately paid off.
But look, understanding a pattern doesn't make it any less terrifying to live through. Between the market's peak in August and the bottom of the crash in October, Magellan's assets just plummeted by $3.8 billion. He later said the entire GNP of Costa Rica was lost in a matter of weeks. He was actually forced to sell good stocks into the panic just to meet shareholder redemptions. It was an absolute trial by fire.
So how did he do it? How did he not only survive that absolute firestorm, but go on to reach even greater heights? Well, it all came down to a set of core, enduring principles that really underpinned his entire strategy from day one.
And this slide, right here, this reveals his single greatest strength: flexibility. Just look at his biggest winners of all time. You've got a financial company, 2 automakers, a tobacco giant, a telecom, a huge conglomerate. He wasn't just a growth investor or a value investor. He completely refused to be put in a box, and that's what freed him up to chase the best opportunities, no matter where they were hiding.
And in the end, his wisdom isn't some complex, secret Wall Street formula. It's just practical, common-sense advice for anyone. He taught us to reevaluate what we already own, to stay flexible, to do the homework, to be humble enough to admit when you're wrong and sell your losers, and maybe most importantly, to believe that you, the individual investor, can spot incredible opportunities in your own daily life, often long before the professionals do.
You know, the story of Peter Lynch is just this powerful reminder that curiosity and good old-fashioned diligence can absolutely triumph over Wall Street dogma. This is a guy who found world-beating investments by looking at car companies, insurance rates, and even the syndication rights for Wheel of Fortune. And it leaves all of us with a challenge, really, to look at our own world with that same inquisitive eye and just ask, what's the next great idea that everyone else is missing?
You know, in today's world of investing, it feels like you're drowning in complex algorithms and a constant barrage of financial news. But what if the real secret to success was actually simpler, more hands-on? Well, that's what we're diving into today. We're going to explore the philosophy of the legendary investor Peter Lynch, who really believed that great investing comes down to just 3 things: a little bit of art, a little bit of science, and one absolutely crucial ingredient that most people just completely forget about. So, here's how we're going to break it all down. First, we'll tackle that classic debate: is investing an art or a science? Then, we're going to reveal Lynch's secret weapon, what he called legwork. After that, we'll get into the right mindset, how to think like a master. We'll see how it all works in practice with some real-world examples. And finally, we'll talk about how you can start seeing your own investments as a kind of ongoing story. Okay, first up, art versus science. You know, this is the big dilemma, the fundamental question that really trips up so many investors. They tend to swing hard to one side or the other, and according to Peter Lynch, both of those extremes are just traps waiting to be sprung. So what's the answer? Is it an art or a science? Should you be poring over spreadsheets, or should you just trust your gut? Well, Peter Lynch was pretty clear on this. He believed that treating investing as only one or the other is probably the biggest mistake you can make right out of the gate. Let's dig into why. And this right here is a perfect picture of those 2 traps. On one side, you've got the scientist. This person is just obsessed with numbers. Their head is permanently buried in a balance sheet. They're the type Lynch described as counting the stars and falling in potholes. So focused on the data, they miss what's happening in the real world. And on the other side, you've got the artist. This person runs on pure feeling, on hunches. They think they have a knack for it, but they never actually do the research. Both roads, as Lynch saw it, lead straight to disappointment. I mean, Lynch just nailed it with this quote. Think about it. If picking stocks was just a math problem, accountants would be running the world, right? But they aren't. And that tells you everything you need to know. There has to be another piece to this puzzle. So that brings us right to our next section. If it's not purely art and it's not purely science, then what on earth is it? Well, we're about to uncover what Lynch considered the true missing piece of the investing puzzle. You see, the real trick here is realizing that you don't have to choose. It's a false choice. The Peter Lynch way is all about taking the best parts of both and then adding a third super important ingredient into the mix. And there it is, legwork. It's not some secret Wall Street formula. It's not a complicated algorithm. It's just the simple, powerful act of rolling up your sleeves and doing the real research yourself. You know, I absolutely love this analogy because it's so down to earth. Investing isn't about some flash of genius. It's about patient, methodical searching. It's about turning over rock after rock after rock. And yeah, most of the time you're just going to find dirt. But the more rocks you turn over, the more grubs, the more opportunities you're bound to find. It's purely a game of effort. And let's be super clear about what legwork isn't. It's not about forking over a ton of money for some fancy data service just so you can see what the pros are up to. That's just following the crowd. And it's definitely not about trying to find hundreds of winning stocks. For Lynch, All the data in the world is totally useless if you haven't done your own homework on the company first.
And this is what's so incredibly empowering for the individual investor, for people like you and me. Lynch was a huge believer in what he called the rule of 5. The whole idea is that you don't need this massive portfolio with 50 companies you barely know anything about. You just need to find and truly understand a handful. He did the math. If you own just 5 stocks, and only one of them turns into a 10-bagger, that means it goes up 10 times its value, you've already tripled your entire investment, even if the other 4 do absolutely nothing. That's the amazing power of focused hard work.
Okay, so now we know what to do, legwork. But the how is just as important. This next part is all about getting the psychology right. It's about learning to think like a master stock picker. This right here, this is where Peter Lynch just completely flips the script on how most people think. When the market is soaring and everyone's getting euphoric, what does Lynch feel? He gets depressed. Seriously. Why? Because when everything is overpriced, it's nearly impossible to find a good deal. But when the market is getting hammered and everyone else is running for the hills, that's when he gets excited. He knows that recessions don't last forever, and a down market just means that fantastic companies are on sale. A real stock picker loves a good market crash. So how did he actually spot these bargains in the wild? Well, one of his favorite tools was a brilliantly simple visual he called the earnings line. Just picture a chart that tracks a company's earnings per share over a bunch of years. The theory is pretty simple. Over the long haul, a stock's price should pretty much follow its earnings. It's a visual of the company's real fundamental value. The trick is to just compare the stock price to that earnings line. And using it is really straightforward. It's a quick gut check. If you see that the stock price is hugging or even better, has dipped below the earnings line, you might have just found yourself a bargain. It means the price is tied to the company's actual performance. But, and this is a big but, if that price line has shot way, way above the earnings line, Lynch called that the danger zone. That's a massive red flag. It suggests the stock has become totally detached from reality and is probably due for a fall. All right, theory's great, but let's see what this looks like when the rubber meets the road. We're going to dive into how Lynch actually applied these principles by looking at how he reviewed his own stock picks a year after he first recommended them. And this is so important to get. The work and legwork means it's not a one-and-done thing. It's a continuous process of checking in. So before he made his 1992 stock recommendations for the magazine Barron's, he actually went back and re-examined every single one of the 21 stocks he picked the year before. He had to ask himself, does the original story I fell in love with still hold true? So let's really dig into his thought process here. Take Cedar Fair, the amusement park company. The stock price went up. Awesome, right? Well, not so fast. That price increase pushed its dividend yield way down, from a juicy 11% to 8.5%. Since he didn't see any big earnings growth coming, the story had changed. It wasn't a bargain anymore, so rejected. Then there's EQK Green Acres. He spotted one tiny note in a quarterly report that suggested they might stop increasing their dividend. To Lynch, that screamed short-term desperation. Rejected. But then you have Fannie Mae. Its price was up too, but its core business was still firing on all cylinders. The story was still strong. He kept it. And the big lesson from all this, it's so simple, but so many people miss it. The stock price by itself tells you almost nothing. A stock that's gotten cheaper isn't automatically a buy, and one that's gotten more expensive isn't automatically a sell. The real decision always comes down to the underlying story of the business, and that's a story you only learn through constant legwork. Okay, this brings us to our last section, and honestly, I think this is the most powerful idea of them all. This is about completely reframing how you think about investing, shifting it away from being just about transactions and towards something much more personal and much more long-term. Just let that sink in for a second. An investment isn't just a ticker symbol on a screen. It's a living, breathing story. And as long as that company is still in business, that story is still being written. There are going to be new chapters, surprising plot twists. Your job is just to keep reading. So here's how you can put this all together for yourself. It's your game plan. Start with that rule of 5. Find a small, manageable number of companies you feel you can actually understand. Then do the legwork. Get to know their stories inside and out. What do they do? What are their plans? After that, your job is simple. Just check back in on that story every so often. You become the expert on your own small portfolio. And he gives us one last piece of advice, and it's just great for getting over a common mental hurdle. A lot of us have this weird phobia of looking at stocks we used to own, right? If you sold it too early, it's painful to see how high it went. If you sold too late, it's a bad memory. He says it's like ducking behind the cereal display to avoid an old boyfriend or girlfriend at the supermarket. You just have to get over it. That company's story is still going, and a stock you sold years ago might just be a fantastic bargain all over again today. So my challenge to you is this. Tune out the noise. Forget the talking heads and the complicated software for a minute. Instead, just look at the world around you. Look at the companies you interact with every day as stories that are just waiting to be told. The only real question left is the one Peter Lynch would ask you. What story are you going to start researching today? Which rock are you going to turn over first? So, what if I told you that one of the most successful investors in history found his absolute best ideas not by staring at blinking stock tickers, but by just wandering through the local mall? Yeah, I know it sounds a little bit crazy, but today we're going to dive into Peter Lynch's wonderfully simple mall strategy, and it's a powerful reminder that Wall Street's biggest winners are often hiding in plain sight. You just gotta love a quote like that, right? A guy managing billions of dollars says his favorite research spot is right there, next to the food court and the department stores. But look, this isn't a joke. It's actually the core of a really profound idea. As regular consumers, we get a front row seat to what's really happening in business. We see what's working and what isn't, often long before the suits on Wall Street ever catch on. So I want you to completely reframe how you think about a place like this. The mall isn't just a place to go spend your money. For an investor, it's a living, breathing laboratory. Seriously, every single store is an experiment in real time. The length of the checkout lines, how heavy the shopping bags are, the general buzz in the air, all of that, it's data. It's a goldmine of real-world information if you just know how to look. For Lynch, the research actually started before he even parked the car. The drive itself was like a rolling history of American business. He'd pass by companies that had created immense wealth, and then others that had just completely vanished. It's a powerful thought, you know? The businesses we see every day, they aren't just abstract names on a stock market ticker. They are real, tangible parts of our communities, succeeding or failing right in front of our eyes. And what a landscape that is. I mean, think about it. You see an old Radio Shack owned by Tandy where an early bet could have turned $10,000 into $1 million. Then you see a Toys R Us, a stock that went on an absolutely unbelievable run from 25 cents to $36. But you'd also pass an empty building that used to be an Ames department store, a brutal, painful lesson that an investment can go all the way down to zero. And Chili's, that was a personal sore spot for Lynch, who completely ignored his own kids raving about it and missed the entire ride. Ouch. Let's just pause on this for a second. On one hand, you have a life-changing, absolute home run. On the other, a complete wipeout. The key insight here is that both of these companies were household names. Any of us could have walked into their stores, seen how busy or how dead they were, and formed an opinion. This isn't about some complex algorithm. It's just about paying attention to the world around you. It's recognizing that the potential for both incredible success and total failure exists on the very same street corner. So all these drive-by observations and walks through the food court, they start to form a coherent philosophy. It's not just about spotting trends here and there. It's about creating a repeatable process, a fundamental principle for investing in businesses you can actually see, touch, and understand. And this is it. It's so simple you could write it on a napkin, but it is so powerful. If you like the store, chances are you'll love this stock. Now let's be crystal clear. This is not a guarantee. It's the starting point for your research, not the end of it. Think of it as a sign, a clue that a company is doing something exceptionally well to win over customers, and that, my friends, is always the first ingredient in a fantastic investment. So why is this so effective? Well, it works because of the incredible uniformity of modern retail. A product that flies off the shelves in a mall in Massachusetts is almost certain to be a hit in a mall in Texas or California. This consistency in what we like to buy is the engine that allows a great local concept to expand across the whole country, and then the world, fueling years and years of spectacular growth. Okay, so let's see how this whole principle plays out in the real world. Because it's one thing to talk about a theory, right? It's another thing to see how it actually led Lynch to a genuine home run stock. And this particular story starts, as you might guess, with a family trip to the mall right before the holidays. Now, having been burned by ignoring his family's tip on Chili's, Lynch was on high alert. He took his daughters to the mall with a very specific mission: find out what they were excited about. Forget the analyst reports and the quarterly earnings calls for just a minute. The very first signal he was looking for was genuine, unprompted enthusiasm. So where did that come from? Well, he didn't find the idea. They did. They led him right past the Gap, which was already a huge success story, and they made a beeline for this small, really unique store called The Body Shop. And this is such a fundamental part of the lesson. The spark, that initial buy signal, it came from the end user. It came from observing where people were passionately and voluntarily spending their money. And man, it was easy to see the appeal. Just look at this product list. We're not talking about your average bar of soap here. Rasul Mud shampoo? Kiwi fruit lip balm? This stuff was exotic, it felt natural, and it was completely different from anything you'd find at the pharmacy. The store was packed, and people weren't just browsing, they were loading up their baskets. That is a powerful, powerful indicator. But the appeal went so much deeper than just interesting products. This company had a whole philosophy. They used natural ingredients, they recycled everything, avoided animal testing, and even gave employees time off for community service. This wasn't just a cosmetics company. It felt like a movement. People weren't just customers, they were fans. And that kind of passionate loyalty is something you just can't buy with advertising. Okay, so the store is a huge hit with his daughters, and it's always crowded. Time to buy the stock, right? No, not so fast. Liking the store is just step one. That's the fun part. Step two is where the real work begins. You have to take off your consumer hat and put on your investigator hat. You have to do the homework. And for any retailer, this is one of the very first numbers you have to check: same-store sales. It's a simple but absolutely vital metric. It basically answers the question, are the existing stores, the ones that have been open for a while, selling more this year than they did last year? If that number is positive, it tells you the brand's popularity is growing on its own. The good news for The Body Shop? Even in a recession, this number was strong. So the investigation was looking really good. The company's financials were solid, they weren't drowning in debt, and sales were growing at an impressive 20 to 30% a year. Everything was pointing in the right direction. But there's almost always a but when it comes to great companies, isn't there? The secret was out, and the stock was expensive. And that expensiveness is often measured by something called the PE ratio. Just think of it as the stock's price tag relative to its profits. A high PE means investors have really high expectations for the future. Well, The Body Shop was trading at a PE of 40, which is a level that would make most value investors just run for the hills. This was a classic dilemma, a great company at a seemingly high price. But a price tag is only meaningful with context. Look at this comparison. At the exact same time, a blue-chip company like Coca-Cola was growing at a very respectable 15% and trading at a PE of 30. Lynch's logic was this: why would I pay a PE of 30 for 15% growth when I can pay just a little bit more, a PE of 40, for a company that's growing twice as fast at 30%? A faster growth rate can justify a higher price because the company has a much better chance of growing into that valuation. Makes sense, right? So what was the final piece of the puzzle that made him pull the trigger? It was the massive runway for growth ahead. He saw that Canada, with only a tenth of the US population, already had 92 stores. The US only had 70. The math was simple. If a smaller country like Canada could support that many stores, the potential in the US was absolutely enormous. We're talking 900 stores or more. Easy. The company had barely even gotten started. Now, the Body Shop story is fantastic, but the lesson here goes a lot deeper. This strategy isn't about catching lightning in a bottle just once. It's about understanding the nature of long-term business growth. And one of the biggest mistakes investors make is feeling like they're too late to the party. To really get why that's a mistake, we need to look at one of the greatest growth stories of all time. Let's talk about Walmart. By 1980, a full decade after it went public, the stock had already gone up nearly 20 times. Now, the vast majority of people would look at that and say, well, I missed it. The big money has already been made. But here's the astonishing part. If you had bought the stock in 1980, after that huge run-up, you would have made another 50 times your money over the next 11 years. 50. How on earth is that possible? Well, it comes down to this number right here. In 1980, even after a decade of wild success, Walmart stores were located in only 15% of the United States. That means they still had 85% of the country left to expand into. The growth story wasn't at the end, it was still in the early innings. They had a huge untapped market just waiting for them. And that brings us right back to you. The lesson from Peter Lynch isn't just some dusty old history lesson. It's a practical guide. It's about recognizing that your everyday life, the coffee you buy, the clothes you wear, the stores your kids are dragging you into, is a constant stream of valuable market research. Your next research trip isn't to the library. It could be this weekend's trip to the grocery store. The next 10-bagger, the next company that completely changes an industry, might be a brand you already know and use every single day. It's probably hiding in plain sight, sitting right there in your shopping bag. So the question I want to leave you with is a simple one to act on. The next time you're out shopping, take a look. What's in your bag?
All right, welcome to The Explainer. Today, we're doing something really cool. We're going to step right into the mind of a true legend, the investor Peter Lynch. We're going to see exactly how he managed to dig through absolute widespread panic to find some incredible investment opportunities, basically turning the market's biggest fears into his greatest assets.
Okay, so let's really unpack this, because this one sentence, this is the key to his whole way of thinking. This isn't just about buying low, it's about having the courage, the guts to look for value where everybody else just sees risk. It's about doing your detective work in the places that everyone else has already run away from.
So here's our game plan. We're going to structure this whole thing like a detective story. You and me following Lynch's trail of clues from one investment right to the next. We'll get to see his whole method just unfold through a bunch of fascinating real-world case studies. Now, to really understand the genius of the detective, first we have to understand the crime scene. So let's set the stage. The year is 1991. In the media, the markets, the public, pretty much everyone is completely consumed by a single, terrifying story.
You could feel the panic in the air. I mean, every single newspaper, every news broadcast was talking about the real estate collapse. Now, the stories were really focused on commercial real estate, but that little detail got totally lost in the scary headlines. The feeling was that all real estate was going to zero. In Lynch's own neighborhood, he said for sale signs were so common, they looked like, and this is a great quote, the new state flower of Massachusetts. And this fear just got amplified by the very people reporting on it, many of whom owned expensive homes and were watching their own net worth just evaporate on paper.
But this is where Lynch the detective separates himself from the herd. While all the front pages were just screaming disaster, he starts digging through the back pages, the boring data sections. And that's where he found the one clue that pretty much everyone else was missing.
Now check this out. The gap between what people thought was happening and what was actually happening was just massive. The loud story was total collapse. But a quiet fact, buried deep in a report from the National Association of Realtors, showed that the price of the median house in the U.S. was actually rising. In fact, it had gone up every single year since they started tracking the data back in 1968. Think about that for a second. The entire narrative was completely 100% wrong.
And it wasn't just that one clue either. The deeper he dug, the more of these quiet facts he found that just totally contradicted the panic. The Housing Affordability Index? It was the best it had been in over a decade. And why was that? Well, because interest rates were falling, which made mortgages cheaper. All these quiet facts were painting a picture of an inevitable recovery, even as the loud story was just screaming about permanent doom.
So, armed with this incredible counter-narrative, Lynch puts his core strategy into action. See, the entire housing industry had been written off. It was a disaster zone. And that meant it was the perfect time to go prospecting for the strongest, most resilient companies in that industry, which were now selling for bargain basin prices.
His first stop was a quality home builder he knew really well, Toll Brothers. He looked up the stock and found it had just been completely annihilated. It had plunged from over $12 a share all the way down to just $2.03. That's an 81% drop. He called it a five-bagger in reverse, meaning it lost about 80% of its value. And it was crushed by nothing more than just irrational fear.
And this part is so crucial. He totally ignored the stock price and looked at the business itself. And what did he find? Well, while the stock was collapsing, the company's balance sheet had actually improved. Debt was down. Cash was up. They had a 2-year backlog of orders for new homes. And the best part? Their weaker competitors were going bankrupt, which meant Toll Brothers was set up to grab even more market share when the recovery finally came.
But this shows us a key lesson, and it's a big one for prospectors like us. You have to act fast. Lynch found Toll Brothers in October, and he was planning to recommend it in January. But by the time January came around, the stock had already quadrupled, right back up to $12. The bargain was gone. See, bargains in the stock market, they don't stay bargains for long. And realizing this is what led Lynch to his very next clue.
So he was frustrated, right? He missed the obvious opportunity with Toll Brothers because it moved so fast. But Lynch didn't give up. No, he just got more creative. He started looking for the ripple effects, the subtler, secondary ways to profit from the housing recovery that he figured everyone else was probably overlooking.
And the logic here, it's so simple, it's almost childish, which is often the best kind of logic. People moving into all these new and existing homes were going to need to furnish them, right? They'd need lamps and rugs and chairs and all sorts of little knickknacks. And this simple, common-sense observation led him straight to Pier 1, a retailer that specialized in affordable home furnishings.
So he did his homework, of course. He found a company that wasn't just surviving the recession, it was actually profitable. It was expanding like crazy, opening new stores while cutting costs and improving its profit margins. There was this huge block of shares held by one owner, which had been holding the stock price down, and it was finally sold. Oh, and same-store sales were actually up in the parts of the country that weren't in a deep recession. It was just a well-managed company, perfectly positioned for the rebound.
And this is where it gets really cool, how one great idea can lead you right to another one. As Lynch was investigating Pier 1, he picked up the scent of a new trail. See, the Pier 1 story had a little bonus clue hidden right inside it, a company called Sunbelt Nursery.
So to make its own finances stronger, Pier 1 had recently sold off about half of its nursery chain, Sunbelt, in a public offering. Now this move was great for Pier 1. They used the cash to pay down debt, making their balance sheet even stronger. But it also put Sunbelt on the public market, creating a brand new opportunity for a sharp detective like Lynch.
He applied that exact same simple logic. Just like new homes need furniture, they also need landscaping, trees, shrubs, flowers. And he realized that the nursery business was one of the last great fragmented industries, totally dominated by local mom-and-pop shops. It was an industry just waiting for a well-run national chain to come in and start consolidating.
So after just one bad quarter, Sunbelt's stock had been cut in half. So Lynch pulls out his calculator and does some simple comparison shopping. A smaller competitor, Callaway's, had 13 stores, and the market said that company was worth $40 million. Now Sunbelt had 98 stores, more than 7 times as many, but its market value was only $31 million. How on earth could a company with 7 times the stores be worth less? It just didn't add up.
But the trail didn't end there. Following the scent from Sunbelt led Lynch to one of its competitors, a company called General Host. And this case gives us a perfect demonstration of one of Lynch's most famous and powerful tools, what he calls the 3-minute balance sheet drill.
Okay, so here's the situation. General Host was trading for $7 a share, but its book value, which is the supposed value of all its assets if you just liquidated the company, was listed at $9 a share. On paper, it's a great deal, right? You're getting $9 worth of stuff for just $7. But Lynch needed to know, was that $9 book value based on a true story or was it pure fiction?
So he goes right to the balance sheet. First thing he checks is what the company's assets are made of. How much of that book value was hard cash versus something called goodwill, which is kind of a fuzzy accounting number from past acquisitions. He saw that $65 million of the company's $148 million in equity was cold, hard cash. The goodwill was only about 15% of the total, which he figured was a totally non-troublesome amount. The value was real. So Lynch's drill is pretty simple. First, check the assets. See if that book value is solid. It was. Second, check the liabilities. Now, the company did have more debt than equity, which is normally a red flag. But, and this is crucial, it wasn't short-term bank debt that could be called in at any minute. It was long-term debt, which is far less dangerous. The foundation of the company was solid. And then he found one more confirming clue. The company itself had recently been buying back its own stock for $10 a share. I mean, that's a huge vote of confidence. If the company thought its own stock was a good deal at $10, it must be an absolute steal at $7. On top of that, the CEO wasn't selling a single share. And as Lynch's principle says, when insiders are buying, that is a very, very good sign. So, after following this incredible trail of clues, from a national panic, to a home builder, to a furniture store, to a nursery chain, what can we, as investors, actually take away from this masterclass investigation from Peter Lynch?
Here it is, boiled down. The detective's toolkit. First, you have to learn to separate that loud, emotional story you see in the headlines from the quiet, kind of boring facts buried in the data. Then you use those moments of panic to hunt for the strongest companies in the most beaten-down industries. It's also about thinking one step ahead, looking for those ripple effects. What other businesses will benefit from a recovery? Next, use simple back-of-the-napkin math to spot when something is obviously mispriced. And finally, before you pull the trigger, do that quick balance sheet drill and check what the insiders are doing to confirm your whole theory. It's just a powerful framework for thinking on your own and finding value where everyone else only sees risk.
And that's really the big lesson from this whole explainer. You know, the specific companies Lynch bought back in 1991, they're history. But the principles he used, that detective's toolkit he put together, are absolutely timeless. So the final question isn't about what Peter Lynch did way back then, it's about what you can do now. Where is today's panic? What's the industry that everyone has written off? And maybe most importantly, what are the quiet facts out there that might be telling a completely different story?
What if I told you one of the single greatest investment analyses of all time didn't happen in some fancy Wall Street boardroom, but in a Supercuts? Yeah, you heard that right. We're going to break down exactly how the legendary investor Peter Lynch used a simple and, as we'll see, a pretty bad haircut to figure out if he'd found his next big stock. Let's get into it. So let's set the scene. It's 1991. Peter Lynch, a guy who is fiercely loyal to his barber Vinny, is about to do something he never thought he'd do. He's going to cheat on Vinny. Why? Well, a prospectus, that's the big formal document a company puts out when it goes public, it just landed on his desk. The company was called Supercuts. Stock symbol, QUTS. This was never just about getting a trim. This was a full-on, boots-on-the-ground research mission.
And we're going to follow his process step by step. First, we'll look at his field trip. Then, we'll see what clues he gathered with his boots on the ground. After that, we'll analyze the business model he uncovered. Then comes the drama, the customer versus the investor. And finally, we'll see how he made the final call.
All right, first up, the investor's field trip. See, for Peter Lynch, the best investment ideas didn't come from a computer screen. They came from the real world. He had this philosophy that you absolutely had to get out there and, kick the tires yourself to really get what a business was all about.
So the mission was clear. He was going to go undercover. He needed to see this business not as a spreadsheet, but as a living, breathing thing. He wanted to gather that real-world intelligence, the kind of stuff you will never, ever find in an annual report.
And this is where the detective work really begins. The second Lynch walked into that Supercuts in Boston, he wasn't just a customer anymore. He was an investigator. And that waiting room, that was his lab. He immediately started picking up clues.
First thing he does, pulls out a yellow legal pad and jots down the price, $8.95. Now, what does that tell you? Well, it told him it was right in line with what a neighborhood barber like Vinny would charge, but it was way, way cheaper than the fancy salons his wife and daughters went to. Right away, he knew they were going after a huge, price-conscious market.
Next, he looks around the room. He counts. 1, 2, 7. 7 people waiting in line ahead of him. Now, to you or me, that's just an annoying wait. To Peter Lynch, that was a massive signal. It was real-time proof of strong demand. It meant people thought the service was good enough and the price was right enough that it was actually worth their time to wait.
And he just keeps observing, right? He's profiling the scene. Who are the customers? Mostly men, about 80% of them. And who's doing the cutting? Almost all women, about 95%. Just from that simple observation, he gets this crystal clear picture of exactly who Supercuts was built for.
So while he's sitting there, waiting for his turn, he pulls out that prospectus. It's time to connect the dots, to take everything he's seeing and hearing in this little shop and see if it matches up with the numbers and the strategy on the page.
And he sees it almost immediately. This wasn't just a chain of barbershops. He called it the McTrim of barbershops. It was a franchise operation. That means they weren't building all these stores themselves. Nope. They were having other entrepreneurs pay for the privilege of opening a Supercuts. The whole model was built for one thing: explosive nationwide growth.
And the timing? Oh, it was perfect. The old-school independent barbers, they were a vanishing breed. Their numbers were just collapsing. But here's the thing about hair. It doesn't care about the economy. It keeps growing about half an inch every single month. So you had this huge, multi-billion-dollar recession-proof industry with a giant vacuum at its center. It was the perfect opening for a national chain to swoop in.
So how do you grow that fast? Well, you make your franchisees an offer they can't refuse. And the numbers here were just staggering. You could put down about $100,000 to open a store and expect to get a 50% pre-tax return on that money in just 2 years. I mean, with economics like that, finding people to fund your expansion is not going to be a problem. And the model for Supercuts Incorporated, the actual stock he's thinking of buying, was even better. It was beautiful. The franchisees pay for everything. The stylists are super efficient, bringing in about $30 an hour for the store owner. And Supercuts Corporate, they just sit back and collect a 5% royalty on every single haircut, plus another 4% on products. It was an absolute cash machine that required almost no capital from the parent company.
So, the business model is incredible. The market is wide open. All the pieces are falling into place. It's looking perfect. Maybe a little too perfect. And just then, he hears it. Peter? His name is called. And this, my friends, is where our story takes a very sharp and very personal turn.
The haircut was a complete disaster. He said he felt like he'd been attacked by Edward Scissorhands. In one lightning-fast snip, his sideburns were just gone. Poof. He gets home, his wife and daughters take one look at him and just go, "What happened to you?" I mean, he's a 48-year-old guy. This was not the look he was going for.
And this is the moment. This is what separates the legends from the rest of us. Because the customer in him was furious. He swore he would never, ever go back to his Supercuts again. But the investor in him? The investor was staring at this brilliant, efficient, recession-proof business with a massive runway for growth. So what do you do? What do you do when your own personal experience completely contradicts your entire investment thesis?
Okay, so this is it, the final act. A great investor knows you can't let one bad data point, even a really personal one, like a horrible haircut, derail the entire train. So Lynch did what the greats do. He separated his feelings from the financial facts and moved on to his final checks.
He picked up the phone and called the CFO, and he just went down the list. He saw some debt on the balance sheet. Was that a problem? The CFO tells him, "Nope, we'll have that paid off from our own cash flow in 2 years." What about the stylists? Were they any good? Turns out they were all licensed and turnover was really low. He confirmed the growth was all funded by franchisees. And the bad haircut? The CFO just had a good laugh and told him, "Hey, hair grows back." Every single one of his concerns was put to rest.
His final check was on the competition, and what he found just sealed the deal. Other chains like Fantastic Sam's were way less profitable, and the salon chains and malls had much higher rent and were going after a totally different customer. Supercuts had this powerful, defensible niche all to itself, with convenient locations, great hours, and a brand people were starting to recognize.
So, in the end, what won? The lost sideburns or the incredible numbers? Well, the numbers won, hands down. The business fundamentals were just too strong to ignore because of one bad personal experience. He actually went on to recommend the stock on a panel for Barron's magazine, telling the whole world that the questionable haircut he was sporting that day was in fact from Supercuts.
And that whole story just leaves you with one big question, right? Peter Lynch found this amazing opportunity just by being curious about a random business he walked into. So it makes you wonder, what great investment idea did you walk past today? What business are you using every single day that might just be hiding an incredible story, waiting for someone to notice?
All right, today we're going to jump into a really powerful and honestly kind of counterintuitive idea from the legendary investor Peter Lynch. We are going on a treasure hunt, looking for absolutely incredible companies, but not where you'd think. We're looking for blossoms in the desert.
So let me start by asking you a question. Just think for a second. When you imagine a stock that could, really multiply your money, a 10-bagger, where does your mind go? What kind of business, what kind of industry pops into your head first?
If you're like most of us, you probably thought of something exciting, something fast-growing, high-tech, maybe computers back in the 80s, the internet in the 90s, biotech today. I mean, it seems obvious, right? That's where the growth is, so that must be where the money is. But is it?
Peter Lynch just loves this classic Yogi Berra quote, because it perfectly explains this central paradox in investing. See, when an industry gets hot, when it's on the cover of every magazine, what happens? It attracts a flood of smart, ambitious people and a literal mountain of cash. Everybody wants a piece of the action. And well, that's exactly the problem. This right here, it flips the whole idea on its head. Look at the left side, the exciting industry. All those competitors jump in, and they immediately start a price war. It just squeezes the profits for everybody. Now look at the right side, the lousy industry. You know what happens there? The weak players, they just give up. They go out of business. And the tough survivors that are left, they get a bigger piece of the pie.
They have fewer rivals, and they have the power to completely dominate. And this brings us to one of Lynch's core principles. From an investor's point of view, you don't want a fair fight. You want to back the company that's on its way to becoming the undisputed king of its industry, no matter how boring or unglamorous that industry might be.
Okay, so how do we actually find these hidden champions? What are the telltale signs of a company that's about to blossom while all its peers are withering away? Well, Lynch gives us a really clear blueprint. Let's break it down.
These are the key traits. Do you see the pattern here? It's all about discipline. First, they are absolutely obsessed with keeping costs low. They are penny pinchers. They stay away from debt. They treat their employees not like cogs in a machine, but like partners. And this incredible focus lets them find these little overlooked niches and grow at a shocking rate, all while nobody else is even paying attention.
And this principle just illustrates that penny-pinching point so perfectly. Now, it's a bit of a joke, of course, but there's a deep, deep truth to it. Think about it. A company that spends a fortune on a glossy, self-congratulatory annual report is kind of signaling that its priorities might be on image, not on creating real value for you, the shareholder. A simple, no-frills report? That suggests a focus on what actually matters, the business itself.
Okay, so this all sounds great in theory, right? But does it actually work in the real world? Oh, absolutely. Let's dive into some incredible case studies of companies that followed this exact blueprint to achieve just massive success in the most unlikely industries you can imagine. Let's start with an industry that is famous for just destroying money, the airline business. I mean, back in the 80s, it was a graveyard. Giants like Pan Am, Eastern, they all went bankrupt. By all accounts, it was a truly, truly terrible business to be in. And yet, in the middle of this disaster, Southwest Airlines stock went up tenfold. They were the perfect blossom. They focused relentlessly on being the lowest cost operator, and they totally dominated their niche, those short, frequent flights. Their culture was legendarily frugal, right down to the CEO, and while all their rivals were bleeding money, Southwest was profitable every single year.
Okay, let's move to something even less exciting than airlines. How about making cans? Yeah, soda cans, paint cans, pet food cans. It's a commodity business with profit margins that are paper thin. A classic, lousy industry.
But Crown Cork and Seal absolutely mastered this domain. Get this, their expense ratio was an unbelievable 2.5%. Their headquarters? It was a loft above the factory floor. The CEO's annual report had 0 photos, perfectly embodying that earlier principle. And with all the cash they saved, they just relentlessly bought back their own stock, which drove up the value for shareholders. Brilliant.
All right, next up, the American steel industry. In the 80s, this was a symbol of industrial decline. It was getting crushed by foreign competition. The giants like U.S. Steel, Bethlehem Steel, they were just shells of their former selves. A terrible place to invest, right?
Wrong. Not if you'd invested in a maverick company called Nucor. They were run from this modest little office. They had no corporate jets, no fancy perks. Their whole culture was egalitarian. In bad times, the CEO and the factory workers took pay cuts together. In good times, everybody got a bonus. They guaranteed no layoffs, which earned them incredible loyalty, and they invested heavily in new technology to make sure they stayed the low-cost producer. And the result? A 75-fold return on investment. Unbelievable.
Let's keep going. Let's look at another industry that just hit the skids. Carpets. After a boom in the 60s and 70s, homeowners rediscovered wood floors, and the whole carpet business just went into a nosedive. Half of the top manufacturers went out of business.
And this is where Shaw Industries just cleaned up. As the rivals failed, Shaw, the low-cost producer, just swooped in and picked up all their business. They were obsessed with costs. They even bought their own factories and their own trucking fleets. And the result? 20% annual growth in a non-growth industry, and a 50-fold return on the stock. Just a stunning example of this principle at work.
Okay, for our last example, let's look at a company that benefited from a total industry meltdown. The business was making loans for mobile homes, and in the late 80s, sales were plummeting and defaults were just soaring.
The crisis was so bad that the major players, like Citicorp, they just fled the business. They ran for the hills. This left Greentree Financial is basically the last company standing with the entire field to itself. And get this, even after a negative magazine story came out about them, the stock tripled in 9 months.
It just goes to show you that being the sole survivor in a lousy industry is an incredibly profitable place to be. So these stories are fantastic, but how can we use this Lynch lens to spot the next Southwest or the next Nucor? Let's distill all of this down into a simple, actionable framework you can use.
Here it is, the 4-step process. First, you identify a lousy industry, something boring. Step 2, you find the low-cost survivor within it. Who's the toughest one? Third, you check for those blossom traits we covered, that frugality, low debt, good employee relations. And finally, step 4, you confirm its rivals are struggling or even fleeing the business. If you can find a company that ticks all these boxes, you may have just found your very own blossom in the desert.
So if you take just one thing away from all this, let it be this. The biggest opportunities are often hidden in plain sight, and they're usually disguised by boredom. The market overlooks these companies, and that is where your advantage lies.
And let's end with the words of the man himself. This one sentence just perfectly captures the entire philosophy. It is not about finding the next big thing. It's about finding a dominant player in a forgotten corner of the economy. That is the real secret to finding these amazing multi-bagger stocks.
So I'm going to leave you with a final thought to ponder. Just look around you. Think about the most boring, unglamorous, slow-growth industries you can possibly imagine. Waste management? Industrial cleaning supplies? Commercial roofing? Somewhere, in one of those fields, a maverick company might be quietly, methodically getting ready to blossom. Thanks for joining me.
You know, back in the late 1980s, there was one part of the financial world that was basically a 4-letter word. S&L, savings and loans. They were all about collapse, fraud, and this unbelievable $500 billion taxpayer bailout. So naturally, every sane investor was running for the hills. But not the legendary Peter Lynch. He ran toward the fire. So how on earth did he find a gold mine where everyone else just saw a dumpster fire? Let's get into this absolute masterclass in contrarian thinking.
You've got to picture this. The whole idea of a thrift, as they called them, it used to conjure up this really wholesome image, right? Think Jimmy Stewart in It's a Wonderful Life, the friendly community banker helping families buy a home. But by the end of the 80s, that whole image was just shattered. It got replaced by news clips of guys like Charles Keating being led away in handcuffs. All the trust was gone. And fear, well, fear took its place. So here's how we're going to break down Lynch's playbook. First, we'll look at that crisis of confidence. Then we'll dive into his contrarian view. After that, we'll learn his simple 3-part framework for sorting through the mess. We'll dissect what made the good ones so good, build a practical scorecard you can use, and then wrap up with the big lesson this all holds for us today. First things first, it is absolutely impossible to overstate the sheer panic that was going on. This wasn't just some minor dip in the market you could kind of ignore. No, this was a full-blown, front-page, headline-grabbing crisis for years. And this is the number that just terrified everybody. $500 billion. That was the estimated price tag for the bailout. And who paid that bill? Ordinary taxpayers. You and me. This massive, astronomical number just cemented this idea that the entire S&L industry was one giant black hole of fraud and failure.
So with this constant fire hose of bad news, bankruptcies, lawsuits, guys getting hauled off to jail, S&L stocks became Wall Street's untouchables. I mean, you couldn't even mention the term without people getting nervous. The whole sector was considered completely radioactive.
But right in the middle of all that chaos, all that widespread panic, Peter Lynch saw something totally different. He looked right past all the scary headlines and just started digging into the actual numbers.
Okay, so here was his crucial insight. He argued that the market, in its panic, was just throwing the baby out with the bathwater. It was painting this entire industry with one big black brush, treating every single S&L like it was a criminal operation. But the truth, the hidden truth, was that hundreds of them were actually run very conservatively, they were profitable, and they were in fantastic financial shape.
And he had the data to back it up. This right here proved his point. He looked at the equity-to-assets ratio, which is just a fundamental measure of a bank's financial muscle. And what he found was incredible. Lynch found over 100 S&Ls that were, by this simple metric, stronger than the nation's strongest bank at the time, JP Morgan. I mean, look at People's Savings Financial at 12.5%. That's more than double JP Morgan's ratio. This was the hidden truth nobody was talking about.
So, to make sense of all this chaos, Lynch didn't just see one big, confusing mess. Nope. He broke the entire industry down into 3 really distinct categories, and this gave him a super powerful framework to work with.
First up, you had what he called the bad guys. And these guys weren't just bad at their jobs. They were straight-up crooks. They were often privately owned, which meant they could operate in the shadows, running schemes designed for one thing and one thing only, to line their own pockets.
And their scheme was actually pretty simple. First, they'd suck in huge amounts of cash by offering crazy high interest rates on CDs, which, by the way, were insured by the government. Then, they'd turn around and lend all that money out to their buddies for shady projects. Step 3, they'd skim enormous fees right off the top and book it as profit. And those fake, paper profits allowed them to raise even more money and just do it all over again until the whole thing came crushing down.
All right, the second group Lynch identified were the greedy guys. Now, these managers weren't necessarily criminals, but man, were they reckless. They saw the bad guys getting rich quick, and they abandoned all their old-fashioned, sensible lending practices to chase the exact same risky deals. And of course, when the economy turned, their loan portfolios just completely collapsed.
And finally, that brings us to the heroes of the story, the Jimmy Stewarts. These were Lynch's favorites. They were the boring ones, right? The low-cost, no-frills operators who never ever strayed from their main business, taking in deposits from the local community and making simple home mortgage loans. While everybody else was chasing excitement and danger, they were just quietly and consistently making money.
So what did one of these Jimmy Stewart S&Ls actually look like on the inside? What were the specific things that made them such great, overlooked investments? Well, turns out their playbook was surprisingly simple.
Their whole playbook, which was perfectly shown by a company called Golden West Financial, was built on one simple principle: frugality. They were cheap and proud of it. They kept their overhead costs ridiculously low. They completely avoided all the risky fads like junk bonds, and they never wasted a dime on fancy headquarters, celebrity endorsements, or even ATMs. They just stuck to what they knew, which was home loans.
And this story about Marion Sandler, one of the managers of Golden West, it is just perfect. It tells you everything you need to know. In the mid-'80s, she gets up to give a speech to other S&L managers on expense control. A third of the room got up and walked out. They wanted to hear about exciting new stuff, not the boring hard work of cutting costs. That single moment just captures the massive difference in thinking between the smart Jimmy Stewarts and the doomed greedy guys.
Okay, so Lynch had his framework. He knew what he was looking for. Now, let's get down to brass tacks. He created a simple checklist, a scorecard, to help him separate the hidden gems from all the junk.
This is really where the theory becomes an actionable investment strategy. He figured out a few key numbers that could tell you, very quickly, if an S&L was a fortress of financial strength or just a house of cards waiting to fall over.
And here they are. First and most important, that equity to assets ratio. Lynch wanted to see that over 7.5%, the higher the better. Second, high-risk assets. You wanted that to be less than 10% of their loans. Third, 90-day non-performing assets, that's loans that are already going bad, should be under 2%. And then finally, the bonus round. He looked for stocks that were selling for what they were worth on paper or even less. It's a simple checklist, but incredibly powerful for finding quality on the cheap. And just to really hammer home how important that first metric is, take a look at Homeport Bancorp. It had a 20% equity to assets ratio. Lynch called it perhaps the strongest financial institution in the modern world. I mean, it had almost 4 times the capital safety net of JP Morgan. This wasn't just safe, it was an absolute fortress. This is the kind of hidden strength Lynch was looking for. So, you have to be asking yourself, why was this incredible opportunity just sitting there, right out in the open? Why could a regular person find what all the supposed experts on Wall Street were completely missing? The answer, in one word, is neglect. This number right here is just staggering. At the height of the crisis, fewer than 10 analysts were assigned to cover the entire thrift industry. At the same time, a single company like Philip Morris had 46 analysts following its every move. The S&L sector wasn't just unloved, it was a ghost town. And this all leads us to one of Peter Lynch's most timeless and powerful pieces of advice. The moment of maximum pessimism, when things look the absolute bleakest, when even the professional analysts have given up and gone home, that is often the moment of maximum opportunity.
When you really boil it all down, the S&L crisis teaches this powerful lesson. Markets get emotional, and that pessimism often creates incredible bargains in places nobody is looking. The real trick is to figure out what's truly broken versus what's just misunderstood. And that leads to the essential question for all of us today. Where are the headlines awful? What industries have been left for dead? Where are the analysts bored stiff? Because that, according to Peter Lynch, is exactly where the next Jimmy Stewarts are hiding.
All right, so how did a guy like Peter Lynch, one of the greats, consistently uncover those monster stocks? The 10-baggers, the ones that go up 10 times what you paid for them. Well, he didn't have a crystal ball. Nope, he acted like a detective. And in this breakdown, we're going to follow his trail and see exactly how he investigated one of his favorite hunting grounds, the humble savings and loan.
For Lynch, reading an annual report, that was just opening the case file. The real detective work, the part where he got his real edge, started right where most of us would stop. And it all came down to one simple, almost old-fashioned tool, the telephone. He knew, deep down, that if you really want to understand a business, you've got to talk to the people who are actually running the show. Okay, section 1, on the phone with CEOs. This is step 1 in Lynch's playbook. It's all about gathering intelligence right from the source. And listen, this wasn't about some tough guy interrogation. No, it was more like a masterclass in conversation, a way to get the real story, the one hiding behind all the numbers. And here's the thing that's so brilliant about his technique. He never, and I mean ever, started a call by just blurting out, "So, what are your earnings going to be next quarter?" He knew that's a total dead end. His first goal? Just to build a real human connection. Because let's face it, people open up when they're comfortable, right? Not when they feel like they're being put on the spot.
And this is a perfect example of his method in action. So he calls up the chairman of a place called Glacier Bank Corp, way out of Montana. Does he start with tough questions about their loan portfolio? Nope. He starts chatting about the things a local would care about. The mountains, the timber industry. He even brought up the local ski area. He was just building that common ground, piece by piece.
So once he'd built that connection, and only then would he make his move. He'd skillfully pivot the conversation, easing to the real meat of it, the serious investment questions. And he wasn't just asking blind questions. He'd sprinkle in little tidbits to show he'd actually done his homework. It was this beautiful, subtle shift from just a casual chat to a full-on deep dive.
And we're not talking about generic cookie-cutter questions here. He'd ask about, say, new branches to get a feel for their growth plans, or he'd ask about a recent company they bought. But he'd do it in a clever way. He'd say something like, "Wow, I bet you had to pay way over book value for that one," just inviting the CEO to jump in and correct him. But my absolute favorite, he'd ask, "So, which competitor do you admire the most?" Think about that. That one question alone often pointed him directly to his next big investment.
Now this quote is exactly the kind of thing that would make Peter Lynch's ears perk up. The CEO says, "We have a very boring story." To Lynch, that was like music. See, in the world of banking, boring is beautiful. Boring means stable. Boring means they're not taking crazy risks. And when he says fortress balance sheet, well, that just means when things get tough and the other guys are walking the plank, this company is going to be just fine.
Okay, section 2, decoding the balance sheet. So the detective has gathered all his intelligence from the field, right? The phone calls are done. Now it's time to head back to the lab. Time to put those financial statements under the microscope and see if the story the CEO is spinning actually lines up with the cold hard numbers. So Lynch had this kind of mental checklist, a quick litmus test to separate the good from the bad. It's pretty simple, really. He liked boring, old-fashioned names, not the flashy Bancorp ones. He wanted to see a company buying back its own shares. That's a great sign. Not watering down your ownership by issuing more. And the big ones? He looked for a really strong equity-to-assets ratio. That's your safety cushion. And he got real nervous when he saw a ton of high-risk commercial lending. That was a major red flag.
And speaking of that equity ratio, check this out. 13%. For a bank, that's fantastic. Think of it this way. For every single dollar of assets they have, they've got 13 cents of their own money as a safety cushion. Now that might not sound like a lot, but in the banking world where margins can be razor thin, a number like 13%, well, that tells you this place is a rock. It's built to last.
But here's the thing. Lynch wasn't just hunting for perfect, squeaky clean companies. Nah, he was also a bit of a bottom fisher. He loved digging through the bargain bin, looking for companies that had fallen on hard times. But to analyze these, let's call them born-again S&Ls, you needed a special kind of stress test. You had to know if they could actually survive a storm. And his test was so simple, it was brilliant. Take this one struggling company, First Essex. Lynch looked at just two numbers, First, their total risky commercial loans, $46 million. Second, their total equity, their own skin in the game, also $46 million, a 1-to-1 ratio. So he thought, okay, let's assume the absolute worst. Let's say half of those risky loans go belly up. Well, they'd lose half their equity, but they'd still be standing. They survive.
Now, to really see why this matters, let's look at their competitor right down the street, Lawrence Savings. They had more risky loans, about $55 million, but way less equity to back it all up, only $27 million. So their risky loans were double their equity. If you run the same stress test, if half their loans go bad, poof, they're wiped out, gone. It's an amazing contrast, right? Just two numbers and you can see the hidden danger. Okay, section 3. Now, finding a solid turnaround story is great, but Lynch's detective work uncovered something even better. He found a very specific, special situation that he called an almost can't-lose proposition. It was like finding a glitch in the system, a little-known quirk in the market that could create massive value literally from day one. And Lynch had the perfect analogy for this. Just imagine, you buy a house, you write out that huge check for the down payment. Then, a week later, you're unpacking, you open a kitchen drawer, and inside is an envelope stuffed with cash. It's your entire down payment, with a little note that just says, "This is yours now." Sounds crazy, right? Well, that's pretty much what was happening when these special kinds of savings and loans decided to go public. So here's the magic trick. There's this thing called a mutual S&L. Now, it's not owned by shareholders, it's owned by the people who have their money there, the depositors. When one of these decides to go public, they sell stock just like any other company. But here's the kicker. All the money they raise from selling that stock doesn't go to some founder or venture capitalist. It goes right back into the company's own vault. So think about it. If a company is worth $10 million and they raise $10 million selling stock, boom, it's instantly worth $20 million. And that right there is the whole game. Book value is just a fancy term for what a company is worth. Its assets minus its liabilities. So in our little example, you just bought shares that cost you, say, $10. But those shares immediately represent a piece of a company that now has a book value of $20 per share. You were basically buying $1 worth of assets for 50 cents. An instant discount right from the get-go. And listen, this wasn't just some theory on paper. The real-world results were absolutely staggering. Look at 1991. 16 of these mutuals went public, and pretty much all of them doubled or even better. One of them, Magna Bancorp, turned into a 10-bagger in just a couple of years. And the next year, 1992, same story. The vast majority of these IPOs shot up over 50% in less than 2 years. Just incredible. But this is what's truly mind-blowing. This is the margin of safety we're talking about. Even if you had the worst luck in the world, I mean, you picked the 5 absolute worst performing S&L IPOs of 1992, you still would have made a 31% return. You still beat the S&P 500. Just think about that. When your losing picks are still winners, you know you've stumbled onto something really, really special. So let's bring this all together in section 4. The biggest takeaway here is that this is not just some dusty history lesson about a Wall Street giant. Lynch was adamant about this. These ideas are perfect for everyday investors. In fact, he argued that you have a real advantage over the pros on Wall Street. Just to give you some perspective, back when Lynch was writing about this, there were still more than 1,300 of these mutual savings banks that hadn't gone public yet. Think about that. Over 1,000 potential cash-in-the-drawer opportunities just sitting there, waiting to be discovered. And they weren't hidden away in some complex financial world. They were in plain sight, in towns and cities all over the country. So this is basically your own local detective kit. It's the ultimate invest-in-what-you-know strategy. I mean, what's closer to home than your local savings bank, right? The place where you might have a checking account? Lynch's point was, you could literally just open an account there, and that might give you the right to buy in if they ever go public. And then you do your own detective work. You read the paperwork, you check to see if the insiders are buying with their own money, and then you make your own informed decision. And that right there is the heart of Peter Lynch's method. It's a powerful reminder that the best investments aren't always the flashy, famous companies that everyone's buzzing about. Sometimes the most profitable finds are those boring little stories right down the street from you. So the only real question left is, what hidden opportunities are waiting in your own backyard? And are you willing to do a little detective work to find them?
All right, today we're going to dive into the mind of a true investing legend, Peter Lynch. We're looking at a very specific, kind of dusty corner of the market that most people just walk right past, master limited partnerships, or MLPs. You know, it's funny, Lynch found some of his absolute biggest winners in this area, a place that Wall Street had pretty much given up on. And that really gets to the heart of it, doesn't it? It's a question every smart investor should ask themselves. What if an entire class of companies was so misunderstood, so wrapped up in a bad reputation, that it was basically a treasure chest of bargains just waiting for someone like you to come along and take a closer look? Well, that's the exact situation Peter Lynch stumbled into with these MLPs.
So, here's the setup. On one side, you've got the reputation. People hear limited partnership and they think of, boondoggles, shady tax shelters from the 70s and 80s, just a complicated mess. But Lynch saw the other side of that coin. He saw the opportunity for these incredibly high dividend yields, businesses that were actually dead simple to understand, and, because of that nasty reputation, prices that were just in the bargain basement. So let's really dig into why this bargain bin even exists. It almost all comes down to what Lynch calls guilt by association. It's like the name itself, limited partnership, just gives investors these flashbacks to old failed tax schemes. And that fear, that memory, it's so strong that it keeps them from even looking at what are often fantastic, profitable, and totally legitimate businesses today.
And if the bad reputation from decades ago wasn't enough to scare people off, there's this little thing, a tiny little hurdle. MLPs require a special tax form, a K-1. Now, get this, the company basically fills the whole thing out for you, but the mere thought of an extra piece of paper at tax time is enough to make hordes of investors, and especially the big-shot institutional fund managers, just throw up their hands and say, nope, not for me. And that right there, that laziness, is a massive advantage for the rest of us.
And this quote, this is pure Peter Lynch. It just perfectly captures his whole philosophy. He didn't see the paperwork as a problem. He saw it as a feature. It was like a protective moat that kept the crowds and all their money away from his turf. He would have filled out forms in ancient Sanskrit if it meant keeping these stocks unpopular, because that unpopularity is exactly what kept them cheap.
Okay, so it's one thing to know that there's a bargain bin out there. That's the easy part. The real trick is knowing how to sift through all the stuff in it to find the actual gems. And for that, Lynch had a very specific, very clear checklist.
His approach was just beautiful in its simplicity. First, as we've already covered, the unpopularity is key. That's what creates the low prices. Second, he absolutely loved that these weren't some black box tech companies. Nope, they were boring, simple, easy to grasp businesses. And third, because of their special structure, they had to pay out almost all of their earnings directly to the shareholders. Put those three things together and you have one heck of a powerful recipe for an investment.
And just so we're all crystal clear on what we're talking about, let's nail down the definition. An MLP is a company you can buy and sell on the stock market, just like anything else. But behind the scenes, it's structured as a partnership. The key thing to remember is that it acts like a pipeline. The profits flow directly through the company right into your pocket as the shareholder, without getting hit by corporate taxes first. And that's the secret sauce behind those big payouts.
And when Lynch says down to earth, he is not kidding. I mean, look at this list. We're talking about the Boston Celtics basketball team, a cleaning service, an amusement park company, a shopping mall, an auto parts distributor. These are businesses you can literally see, touch, and understand. You don't need a degree in finance to figure out how they make money.
Okay, the theory is great, right? But the real magic, the real lessons, they're always in the stories. So let's stop talking on hypotheticals and see how Lynch actually put this stuff into practice. We're going to walk through two specific companies he invested in and see how his checklist played out in the real world. So first up, we have EQK Green Acres. And the business model here, well, it was about as simple as it gets. The company's main asset was one thing, a single, giant, enclosed shopping mall out on Long Island. That's it. This was a business Lynch could, and actually did, go visit himself. He could walk around, check out the stores, even buy a pair of shoes. Talk about knowing what you own.
Now, what's fascinating about this one is that it tells a whole story. When Lynch first found it, the appeal was just screaming at him. A massive 13.5% yield? Check. Management owned a huge chunk of the stock, so they had skin in the game? Check. Simple business, low vacancy rates? Check, check. But then, about a year later, he started to see some cracks. The company broke its long, proud streak of raising the dividend. That's a huge red flag. And all the great news about landing Sears and JCPenney as new tenants, well, it was just a rumor. There were no signed contracts. On top of that, a bad holiday season was hurting all the existing tenants, which meant rents were under pressure.
And this right here is the million-dollar lesson from the Green Acres story. Don't buy on rumors.
Look, buying a stock because you think a big contract is about to be signed is just gambling. Lynch knew that waiting for the official press release, waiting for the ink to be dry, might mean he'd miss the first couple of dollars of the stock's upward move. But you know what? It also protected him from losing a whole lot more if the deal never happened. Waiting for proof, that's how the pros play the game.
All right, next up, we've got Sun Distributors. And this story is just fantastic. It's a perfect example of a company that, from the outside, just looked like a complicated, boring, confusing mess. But Peter Lynch, being Peter Lynch, looked right past that messy exterior and found an absolute gem hiding inside.
So from the outside, this thing had all the warning signs for a lazy investor. It was an MLP, so you had that dreaded paperwork. It had 2 different classes of stock, which can be confusing. And of course, it was completely ignored by Wall Street. But the inside story? Oh, it was beautiful. At its core, it was just a simple business that sold auto parts and industrial glass. More importantly, it was an incredibly efficient, low-cost operator, and the guys running the show had huge incentives to make it succeed.
And if you want proof of how strong this business was, you just had to look at the numbers. They had a gross margin of 60%. Let me put that in perspective. For every dollar of stuff they sold, 60 cents of it was gross profit before you even get to other expenses. That's a huge number, and it was the proof Lynch needed. It showed him this was a lean, mean, low-cost machine, the kind of company that doesn't just survive a recession, but actually gets stronger because all its weaker competitors go belly up.
Now, to really understand the secret of Sun Distributors, you have to get your head around this concept of free cash flow. Forget the earnings per share number you hear on TV for a second. Free cash flow is the real deal. It's the actual cold, hard cash that a business pulls in from its operations. And often, this real number is way bigger than the official earnings because accounting rules can make a company look less profitable than it truly is. And here it is. This was the secret Lynch unlocked. Sun's officially reported earnings were $1.25 per share. Not bad. But Sun had bought a ton of other little companies over the years. And because of an accounting rule, it had to subtract a non-cash expense for something called goodwill every single year. When Lynch simply added that made-up expense back in, he realized the company's real cash earnings were almost double what Wall Street saw. This was the hidden value, the mispricing that he lived for.
And what did the brilliant management at Sun do with all this secret cash they were generating? Well, they played it perfectly. When the economy was booming, they used that cash to go out and buy 36 other companies, fueling their growth. But then, when the recession hit, they pivoted instantly. They slammed the brakes on acquisitions and started using that same fire hose of cash to pay down their debt, making the company stronger and safer. That right there, that is the incredible flexibility and power that strong, real cash flow gives a business.
So, we've walked through the theory. We've looked at the real-world stories. What's the big takeaway here? What does this all mean for you, the individual investor trying to make sense of all this? How can you actually use these lessons from a master like Lynch?
Well, I think it really boils down to 4 simple, powerful ideas. First, have the courage to look in the places no one else is looking. Wall Street's neglect is your best friend. Second, remember the story is always more important than the spreadsheet. You have to understand the actual business. Third, be patient. Wait for the proof. Don't gamble on gossip and rumors. And finally, and maybe most importantly, never forget that cash flow is king. It's the ultimate measure of a company's real health and strength.
And that kind of leaves us with one final question to think about. The next time you're out and about, just look around. Look at the boring businesses you drive past every single day. The industrial parts distributor, the regional cleaning service, the local amusement park. Peter Lynch's ultimate lesson is that inside one of those boring buildings, there just might be an absolutely incredible investment story hiding in plain sight, if you're just willing to do a little bit of digging. And that's our look into Peter Lynch's playbook for master limited partnerships. Every single one of these insights today comes directly from his phenomenal book, Beating the Street. Thanks so much for tuning in.
Today, we are diving deep into the mind of the legendary Peter Lynch to unpack one of his most powerful and honestly most counterintuitive investment strategies. We're talking about cyclical stocks. In the Thai version of his book, this chapter had a great title, Hun Watachak, Sing Ti Won Wien Glap Ma, which basically means what goes around comes around. And that simple phrase is really the key to unlocking a huge opportunity that most investors just completely miss.
So let me just start with a question that's going to turn a lot of what you think you know about investing completely upside down. Imagine this. You find a company that's posting its best profits ever. The stock looks incredibly cheap. It's got a super low PE ratio. I mean, every instinct in your body is screaming buy, right? But what if I told you that in some industries, that is the single worst thing you could possibly do? This little paradox, well, that's what we're all about today. And that leads us right into what I call the cyclical investing riddle. You see, some industries move in these really predictable patterns, kind of like the seasons. You have your spring, your summer, your fall, your winter, a boom, and then a bust. Their fortunes are tied directly to the health of the overall economy. And if you can get the timing right, the opportunity is just massive. But that timing, that's what makes it one of the trickiest and most dangerous games on Wall Street. So what kind of companies are we talking about here? Well, think about industries that sell big, expensive stuff, or the basic materials to make that stuff. When the economy is booming, people go out and buy new cars. Companies expand, so they need more steel. We travel more, so airlines do well. Chemical and paper usage goes up. But the minute a recession hits, those are the very first things people and companies stop spending money on. And this creates these huge, dramatic swings in their profits, a pattern that Lynch says is as reliable as the changing of the seasons. Now here's the real problem. You're not the only person who sees this pattern happening. All the pros, the big fund managers, they see it too. And they are in a constant race to be the first one in. They're trying to buy these stocks before the good news is obvious, trying to get ahead of the turn earlier and earlier and earlier. And all of that anticipation makes this a real minefield for the average investor. It's so easy to buy too soon, watch the stock do nothing, get frustrated, and then sell right before the real party starts. But this is where the genius of Peter Lynch just shines. He looked at this trap, this thing that scares everyone else away, and he didn't see danger. He saw a massive opportunity. And he came up with a set of really simple but totally profound rules that just flip the whole approach to these stocks on its head. So let's break down how he cracked the code. And this slide right here lays out the whole paradox perfectly. For almost any other kind of stock, a low PE ratio is a green light. It's the market telling you, hey, here's a bargain. But Lynch teaches us that for cyclicals, it is the exact opposite. It's a screaming red flag. That low PE doesn't mean the stock is cheap. It means the E, the earnings, are at their absolute peak, and a steep, painful drop is probably right around the corner. So, let's walk through how this trap actually plays out in the real world. It all starts at the top when things look great. The company reports these amazing record-breaking profits. The stock price hasn't quite caught up yet, so the PE ratio looks insanely low, maybe a 3 or a 4. Now, the unwary investor sees this and thinks, wow, what a deal. They hold on, maybe they even buy more. But the smart money, the pros who get the cycle, they're already quietly selling their shares. And then the inevitable happens. The economy slows down, and the company's earnings just collapse with breathtaking speed. And the stock price, it goes right down with it, and all those folks who bought up at the peak can easily lose half their money or even more. And there it is, straight from the man himself. I'm just going to let that sink in for a second. A proven method for losing half your money in a short period of time. He's not messing around. He's giving you a crystal clear warning that getting this wrong, following conventional wisdom here, it's not just a small mistake. It is catastrophic for your portfolio. So, if a low PE is the danger zone, then a high PE can actually be a fantastic sign. I know, it sounds crazy, right? A high PE is supposed to mean a stock is expensive. But in the weird world of cyclicals, it often means the company's earnings have just been totally crushed by a recession. That E in the PE is tiny. Sometimes it's even negative. And what that's telling you is that the company has already been through hell. All the bad news is out there, it's priced in, and now it's coiled and ready for a powerful comeback when the economy turns. Okay, theory is great, but let's see how Lynch actually put this stuff into practice. We're going to look at his investment in a copper company called Phelps Dodge. This is just a classic story of finding an unbelievable bargain while everybody else was running for the hills. Now, Lynch wasn't just throwing darts at a board. He had a very clear, repeatable process. First, and this is the most important, he checked the balance sheet. Can this company survive if things get really ugly? Then, he'd do what's called a sum of the parts analysis to find hidden value. He'd dig into the industry itself. What makes copper different from steel? And finally, he did some really simple math to see just how much money the company could make when things turned around. Let's walk through it. Step 1 is always survival. This is non-negotiable.
Lynch pulled up the 1990 annual report for Phelps Dodge, and he saw exactly what he was hoping to see. The company had almost $1.7 billion in equity and only $318 million in net debt. I mean, this thing was a fortress. He knew right then and there that no matter how bad the recession got, no matter how low copper prices fell, Phelps Dodge was not going bankrupt. This is the absolute first question you have to answer with any cyclical.
All right, next up, he started looking for that hidden value. See, Phelps Dodge wasn't just a copper company. They had all these other businesses. They made something called carbon black, they made magnet wire, they even had a gold mine. So Lynch did some back-of-the-envelope math and figured that just those other businesses alone were worth somewhere between $15 and $21 per share. Now, at the time, the stock was trading for about $32, and that was the light bulb moment. He realized he could buy the stock for $32, and he was getting the entire world-class copper business for a massive discount, maybe as little as $11 a share.
Okay, so he knows the company is going to survive, and he knows it's cheap. But the real question is, what's the potential upside? The answer was in this number right here. Phelps Dodge produced a staggering 1.1 billion pounds of copper every single year. That kind of scale creates incredible leverage to the price of the metal itself.
And this is where the simple math gets really powerful. Because of that massive scale, for every single penny that the price of copper went up, Phelps Dodge made an extra 10 cents per share in profit. Think about that. If copper just recovered by, say, 50 cents a pound, which is totally reasonable coming out of a recession, that would translate into an extra $5 per share in earnings. The upside was just enormous. All he had to do was buy it and wait.
All right, let's see this playbook one more time with another classic cyclical industry, cars. This is the story of how Lynch spotted a huge turnaround at General Motors back in 1991, a time when pretty much everyone thought the company was toast. It was all gloom and doom.
For the auto industry, Lynch had this one specific indicator that he absolutely loved. And the funny thing is, he found it in a Chrysler corporate report of all places. It's a concept called pent-up demand. The idea is really simple. Based on things like population and how old the average car is, there's a predictable trend for how many new cars should be sold each year. But in a recession, people put off buying a new car, so actual sales fall way below that trend line. That gap, that deficit, that's pent-up demand.
And you can see it perfectly on this chart. Look at the early 80s, from 1980 to 83. During that recession, car sales fell short of the trend by about 7 million vehicles. That created this huge coiled spring of pent-up demand. And sure enough, look what happened next. From 84 to 89, you get this multi-year boom, where sales were 7.8 million units above the trend. The industry basically made up for all those lost sales. It's like stretching a rubber band and then letting it snap back.
So let's fast forward to 1991. The auto industry is in another major slump. Everyone's pessimistic. But Lynch isn't reading the headlines. He's looking at his pent-up demand chart. And he saw a new deficit starting to build. He ran the numbers and projected that by the end of 93, there would be 5.6 million units of pent-up demand. That told him with a high degree of confidence that a new boom was coming from 1994 to 96. He could invest before any of the good news actually happened.
I love this quote. It is so perfectly Peter Lynch. He wasn't scared off by all the terrible stories about GM losing market share and closing factories. In fact, that's exactly what drew him in. He knew that when sentiment is at rock bottom, when nobody expects anything good to happen, that's when you have the most upside. The risk was low because everyone hated the stock.
And here was the final piece of the puzzle. Just like with Phelps Dodge, he looked at the sum of the parts. He saw that GM's European business, its financing arm, and its other divisions were actually super profitable. They were doing so well that the troubled U.S. car business didn't need some heroic miracle turnaround. All it had to do was stop losing money. If you could just get to break even, the rest of the company was strong enough to earn $6 to $8 a share. The bar was set so incredibly low, it was almost hard not to step over it.
Okay, so we've gone through the theory, we've seen it in action with a copper company and a car company. The patterns are crystal clear. So the question is, how do you and I apply these incredible lessons? Let's boil everything we've just talked about down into a final, actionable playbook. Here it is. This is your checklist. First, know your industry. You can't just jump into steel or chemicals without understanding their unique rhythms. Second, burn this into your brain. Invert the PE rule. Be scared when it's low and get interested when it's high. Third, balance sheet, balance sheet, balance sheet. The company has to survive the winter.
Fourth, do a sum of the parts analysis to see if you're getting a bargain. Fifth, find those key indicators, your own version of pent-up demand that can give you an edge. And finally, you have to be patient and optimistic. As Lynch always said, it never pays to be pessimistic in the long run. And that's what I want to leave you with. The economy is always moving. The seasons are always changing. So using the playbook we just built, take a look around. Which industries today are at the bottom of their cycle? Where is pessimism at an absolute peak? Where are the balance sheets still strong? And where are the first quiet little signs of a turnaround just starting to appear? That's the question Peter Lynch would be asking right now.
All right, let's get into it. We're going to dive into a fascinating and frankly completely counterintuitive playbook from one of the greatest investors of all time, Peter Lynch. We're going to look at a strategy that honestly feels like it breaks every single rule we've ever been taught about investing.
Now, this quote right here, this is the key to everything. Just think about that for a second. Utilities are supposed to be the sleepy, safe, boring part of your portfolio, right? But here is Peter Lynch, a legend, telling us his biggest, most spectacular wins came from the ones that were teetering on the edge of disaster. It just flips the whole idea of safe investing completely on its head.
I mean, you know the drill. Every investment book you pick up, every financial advisor you talk to, they all say the same thing. Find good, strong, stable companies. You want predictable growth, you want a smooth ride, not a roller coaster that's on fire. That's just common sense.
But Peter Lynch wasn't a common sense kind of guy. He did the exact opposite. He didn't just stumble into these messes, he went looking for them. He actively hunted for the companies that had everyone else running for the hills screaming.
And this is where it gets, well, kind of nuts. We're not talking about a company that just had a bad quarter or missed its earnings. Nope. We're talking about companies dealing with the fallout, sometimes literally, of a full-blown nuclear power plant crisis. So you have to ask yourself, right? Why? Why on earth would an investment genius bet the farm on something that sounds so unbelievably terrifying? So what was his secret? What was the secret ingredient he saw that nobody else did? Well, the aha moment, the reason this strategy isn't nearly as crazy as it sounds, it all comes down to one crucial, fundamental difference that sets utilities apart from pretty much every other business out there. And that difference is regulation. See, a utility isn't like a company selling, sneakers or smartphones. It's providing an essential public service. People absolutely need to keep their lights on, keep their homes heated. And because of that, the government has a huge amount of control over how they operate, what they can charge, and even how much money they're allowed to make. And this comparison just lays it out perfectly. Think about it. If your favorite clothing store goes bankrupt, it's a bummer, but life goes on. It disappears, and another one takes its place. That's just capitalism. But what happens if the company providing electricity to an entire state goes bankrupt? Well, that's not a business problem. That's a public catastrophe. The state, the government, has a massive vested interest in making sure that just does not happen. So what it all boils down to is this. The whole system is basically designed for their survival. Now, that doesn't mean shareholders can't get hammered in the short term. They definitely can. But it means the odds are overwhelmingly stacked in favor of the company eventually getting the help it needs to pull through. The risk of the company just vanishing into thin air is way, way lower than in just about any other industry. Now, for Lynch, this wasn't just some gut feeling. He and some other really smart analysts noticed that these crises weren't just random, chaotic events. They actually followed a pretty predictable pattern, a 4-stage cycle that became his roadmap for knowing when to get interested and, more importantly, when to pull the trigger. This 4-stage cycle is really the heart of the whole playbook. It all starts with a total disaster, then it moves into this painful but super necessary crisis management phase, then things finally stabilize, and then, finally, you get the recovery that makes it all worthwhile for the patient investor. So let's walk through it, step by step. Stage 1, disaster strikes. And I mean disaster. This is when the horrible news hits. A planned accident, a project with massive cost overruns, something that just goes completely wrong. The market absolutely panics, and the stock gets crushed, losing anywhere from a staggering 40 to 80% of its value in just a year or two. And look, this isn't just theory. These were real-world train wrecks. Con Ed dropped 75%. General Public Utilities, that was the company that owned 3 Mile Island, got cut by more than half. And Long Island Lighting, an absolute bloodbath, down almost 80%. Imagine owning a safe utility stock and seeing that. It was horrifying. But for Peter Lynch, that was a dinner bell ringing. Okay,
Stage 2. This is where the company battens down the hatches. It's pure survival mode. They slash spending, they put big projects on hold, and, this is the big one, they often cut or completely eliminate the dividend. You know, that quarterly check they send to shareholders? Now, for 99% of investors, a dividend cut is a massive red flag, a signal to sell, sell, sell. For Lynch, it was the starting gun.
By stage 3, the dust is starting to settle. The company has cut its costs so much that it can now survive just on the money it's getting from customers paying their monthly bills. The immediate threat of bankruptcy is off the table. Wall Street is still terrified of it, and it's not really making money for shareholders yet, but it's stable. You could say the patient is off life support.
And finally, we hit stage 4. This is the payoff. 2 really important things happen here. First, the company can go out and borrow money again. The capital markets reopen to them. That's huge. But the second thing is the ultimate green light. The regulators step in and allow the utility to raise rates on its customers. That's basically the government giving its official stamp of approval, signaling that the company is back from the dead. Okay, so that's the theory. But how does this actually look in the real world? There's no better example than the story of CMS Energy. It's a perfect case study of this entire playbook in action. This timeline just lays it out perfectly. So, in 1984, boom, disaster strikes. Their nuclear plant project is a failure. They take a massive financial hit, they kill the dividend, and the stock gets obliterated, down to $4.50. That's stage 1. But then, management does something brilliant. They convert this useless, half-built nuclear plant into a natural gas plant. By 1990, the new plant is up and running great, and the stock has rocketed up to $36. That's a 9-bagger. That's turning your money over 9 times for anyone who was brave enough to buy near the bottom. And this chart right here, this tells you exactly why it worked so well. By converting that failed project, CMS created a plant that could produce electricity for just 6 cents per kilowatt. Now look at the alternatives. A brand new coal plant would have been over 9 cents, and a new nuke plant would have been over 13 cents. They literally turned a billion-dollar mistake into one of the most efficient, low-cost power producers around. That is how you create incredible value from a disaster. So, what's the big lesson here for us? How can you or I actually apply this kind of contrarian against the grain thinking? It really comes down to having a certain mindset and looking for one very simple trigger.
You just gotta love this quote from Lynch. It captures the idea so perfectly. He's saying, look, these situations are filled with panic and drama and terrible, scary headlines, just like a dramatic opera. But because of that government safety net we talked about, they have a surprisingly high chance of having a happy ending for investors who can stomach all the drama. And he boiled this entire complex cycle down to a beautifully simple 2-step strategy. The dividend getting cut, that's the key signal. It means the company is in full-blown crisis mode, and the stock is probably hated and tossed aside by everyone. That's your entry point. And the exit point? When the dividend comes back. That signals the company is healthy again, and Wall Street is ready to love it again. Simple as that. But here's the catch, and Lynch was crystal clear about this. The hardest part of this whole thing isn't the financial analysis. It's the battle inside your own head. You are never going to perfectly time the bottom. It's almost impossible. Maybe the stock bottoms at $4 and you don't buy it till it's at $8. It feels like you missed it, right? You have to just forget that. The journey from $8 to $36 is still an amazing home run. And that really is the lesson from this whole playbook, isn't it? To look for incredible opportunity where everybody else only sees fear. To find value hidden inside the headlines that scare everyone away. And it leaves us with a really powerful question to think about. The troubled nuke was the great contrarian opportunity of Lynch's era. So what's the equivalent today? What industry, what company is facing a crisis so deep that everyone has given up on it, but just might have a happy ending? You know, when you think about a legendary investor like Peter Lynch, you might picture him digging through complicated financial reports, but some of his best ideas came from a much simpler place, a government garage sale. So today, we're going to open up Peter Lynch's playbook and see exactly how he turned these government sales into a gold mine. And this quote, well, this is the whole idea in a nutshell. It's such a great way to put it. When a government decides to sell off its assets, it's a can't-miss event. And for Lynch, this wasn't about politics or anything like that. It was just pure, simple opportunity. The fancy term for this kind of sale? It's called privatization. Lynch himself called this a strange concept. And he's right. I mean, think about it. The government takes something we technically all own, like the water system, and then sells shares of it right back to us. After that, it's a private company. But the key thing, the reason we're talking about this, is that these deals have often been unbelievably good for the people who decided to buy in. So here's the game plan for today. First, we'll look at why these government garage sales are almost set up to succeed. Then we'll dive into a classic example from the UK. We'll see how this pattern went totally global, check out a huge American story with a railroad called Conrail, and then we'll get into the really creative stuff, how to find the hidden angles in all this.
All right, let's get right to the heart of it. Why are these privatizations so often such a great deal for investors? Well, the secret isn't really financial. It's all about politics. And this, right here, is the absolute key. A government just can't afford to sell a big national asset to its own people and then watch that stock tank. Why? Because every single one of those investors is also a voter, and happy investors make for very happy voters. The British government actually learns this the hard way back in the early 80s with a deal called Brit Oil. It totally flopped, and it was a huge political mess. You can bet that after that, they made sure their next deals were basically engineered for success.
This whole experience led Lynch to create one of his most famous principles. It's a little tongue-in-cheek, of course, but it's completely rooted in that political reality. The deals are usually priced to go up, at least at first, because that keeps the voters happy. And to see just how sweet these deals could get, we have to look at one of the best examples ever. Which brings us to this fantastic story that really shows the principle in action. Lynch actually met with a group of British executives, he called them the water lords, who were running the UK's water utilities right before they were sold off to the public. And the deal they described, well, it was almost too good to be true. I mean, just look at how this was structured. It was just layered with goodies for investors. First off, these are natural monopolies. You can't exactly switch your water provider if you don't like the service. Then, get this, the government wiped all their old debts clean. They started with a fresh slate. They even gave them a pile of cash called a green dowry to help pay for upgrades. And the cherry on top, they were basically guaranteed the right to raise prices to pay for everything else. It was like a financial fortress built to succeed from day one.
But the real magic, the true genius of this whole deal, was this little innovation called partially paid shares. Okay, here's how it worked. You could buy a full share of the company, but you only had to put down, say, 40% of the money up front. But, and this is the incredible part, you immediately started getting paid the full dividend, as if you'd paid for the whole thing. This just massively juiced your returns on the actual cash you put in. And this is where the math just gets wild. So the shares paid a really nice 8% dividend. But remember, you only put 40% of the money down. So that 8% dividend on your 40% investment meant your actual cash-on-cash return was a staggering 20%. I mean, think about that. The stock market on a good year returns maybe 10%. This deal gave you double that from the dividend alone before the stock price even budged an inch. It was incredible.
So what was the bottom line? It worked. Big time. Lynch bought every share he was allowed to, and then he bought more. And for regular investors who just bought a mix of these new water companies, their money doubled in only 3 years. This wasn't a lucky break. It was a clear pattern.
And that pattern wasn't just a UK thing. Oh no, this garage sale was going global, and one of the absolute hottest areas was in telecommunications.
The logic here was super simple. Back in the late 80s and early 90s, you couldn't have a modern economy without a modern phone system. It just wasn't possible. So all these developing countries were desperate to build out their networks, and that takes a ton of money. For investors, this was a chance to get in on the ground floor of that massive growth, and these newly privatized national phone companies were the perfect way to do it.
And Lynch, well, he summed up the appeal just perfectly. He said you got the best of all worlds. You got the explosive growth of a small startup, the size and stability of a huge blue-chip company, and the guaranteed business that comes from being a monopoly. It was like getting a second chance to buy AT&T way back in 1910.
And you can see here, this trend was just massive. By 1990, we're talking about $200 billion in worldwide sales. France was selling off its utilities and trains, Scotland sold hydroelectric plants, Mexico sold its airlines, Japan was even talking about selling its famous bullet trains. The garage sale had officially gone global. But what about back home in the States? Now, the US was a little different. We didn't have as many state-owned companies to sell off because most of our big industries were already private. But when Uncle Sam did decide to have a garage sale,
Boy, was it a big one. And the best example of this is Conrail.
Conrail is a classic turnaround story, and it was orchestrated entirely by the government. It was literally built from the ashes of 6 bankrupt railroads, and it lost money for years. But before they sold it, Uncle Sam poured over $7 billion into it. They basically gold-plated the whole thing with brand new tracks and equipment. Then, once it was this perfect, shiny asset, they offered it to the public in 1987. At the time, it was the biggest IPO in American history. So what happened to the investors who showed up for that particular garage sale? Well, the stock was offered at $10 a share. Just a few years later, that same share was trading for $46. That's more than a 4-bagger, all courtesy of Uncle Sam. But the opportunities aren't always so direct and obvious. And this brings us to the final part of the playbook, and maybe the most creative part. You don't always have to buy what the government is selling directly. Sometimes the real money is in the cleanup. And the perfect case study for this was the savings and loan crisis back in the 1980s, a total meltdown that the government had to step in and fix.
So you might be thinking, does the government have to be selling off a big company like a railroad for this strategy to work? And the answer is no, not at all. Sometimes the opportunity comes when the government is forced to sell off assets after a big crisis.
So you've got 2 ways to play this. On one hand, you have the direct sale, like the government selling shares of Conrail. But on the other hand, you have this indirect opportunity. With the S&L bailout, the government wasn't selling shares in a new company. It was selling off all the junk left over from the failed companies. And Lynch found an investment, a company called Allied Capital II, that had a brilliant plan to go in and buy those assets for pennies on the dollar. You see, this government agency, the RTC, was holding a massive garage sale of all these assets from the failed S&Ls. And Allied Capital II, what they did was just brilliant. They carved out a little niche for themselves. They focused on buying bundles of smaller, but still good quality, loans that the big Wall Street banks just didn't want to bother with. They had a great management team, they paid a nice dividend. It was just a really clever, lower-risk way to pick through the best stuff at Uncle Sam's fire sale. And that right there is the big lesson that ties all of this together. It doesn't matter if it's a planned sale of a national railroad or a forced auction after a financial crisis. The principle is exactly the same. When the government is a motivated seller, a smart investor really needs to pay attention.
Peter Lynch's real genius was just applying this simple, powerful idea to the world that was right in front of him. Which leaves us with one final question, and it's not for me to answer, it's for you. What kinds of government garage sales are happening right now, today? And who are the investors out there finding the hidden gems on the tables?
All right, let's talk about one of the greatest investment stories of all time. We're going to open up the personal diary of the legendary investor Peter Lynch and see how his fund made an absolute fortune on a company that Wall Street had totally given up on, Fannie Mae.
And let me tell you, he wasn't kidding. We're talking more than $1 billion in profit from a single stock. But what really makes this story incredible is that Fannie Mae wasn't some hot tech startup. This was a masterclass in doing your homework, having conviction, and seeing a massive business turnaround that everyone else on Wall Street just completely ignored for years. So, how in the world did he pull it off? Well, it wasn't about timing the market. It wasn't some complex financial engineering. The real secret? It was about deeply understanding how a really, really flawed company was quietly turning itself into what Lynch would later call the best business, literally, in America.
Okay, so to really get why the new business was so brilliant, you first got to understand the old Fannie Mae. And the old Fannie Mae, well, it wasn't so much a business as it was a high-stakes casino, where the company's entire fate was riding on one single, totally unpredictable bet.
Their whole strategy sounded so simple, but man was it risky. They called it borrow short and lend long. Basically, they'd borrow money for, say, 3 months at a low interest rate, then use that cash to buy a 30-year mortgage that paid a higher rate, and they just pocket the difference. Sounds easy, right? But it was an absolute recipe for disaster. And here was the problem in a nutshell. When interest rates fell, their borrowing costs went way down, but their income from all those old mortgages stayed the same. They were literally printing money. But, and this is a huge but, when rates went up, their borrowing costs went through the roof, and just like that, their profits would completely vanish. It was a pure, volatile gamble on where interest rates were headed next. You know, Lynch himself actually dipped his toes in back in '77, but got out quick when he saw rates starting to climb.
And he was smart to do so, because by 1981, the whole thing fell apart. I mean, can you imagine borrowing money at 18, 20% just to fund loans that are only paying you 9%? They were bleeding cash, losing a fortune every single day. The stock was basically priced for bankruptcy.
But right when it looked like it was all over, a total transformation began. A new CEO, a guy named David Maxwell, came in, and he was about to give the company what Lynch famously called a major personality change.
So, what was Maxwell's secret weapon? It was an idea he actually borrowed from their smaller competitor, Freddie Mac. It was called the mortgage-backed security, or MBS, and this one concept was about to change literally everything. The new process was just revolutionary for them. Instead of being a lender, Fannie Mae became a processor. Think of it like this. They'd buy up thousands of little mortgages, package them together into one big, easy-to-sell security, and then sell that whole package to a giant pension fund or insurance company. And for all that work, they'd just collect a small, steady fee. The beauty of it? That interest rate risk, the thing that almost killed them, was now passed on to the new owner. They turned themselves into a toll collector on the mortgage highway.
But, there was this one massive problem. This brilliant new business model was completely hidden from view. Why? Because the company was still stuck with what they called the block of granite, a $60 billion portfolio of all those old, low-rate mortgages from the 70s. This thing was a constant drain on profits, and it completely masked how incredibly profitable their new fee business was becoming. And this is where, for an investor, the story gets really interesting. Because even as the business was fundamentally getting stronger and stronger on the inside, the stock was just getting hammered by a perfect storm of fears from the outside world. First up, you had the Texas oil bust. Oil prices crashed, the Texas real estate market completely imploded, and people started defaulting on their mortgages. The analysts, like this one, were predicting total disaster. The consensus on Wall Street was clear. Stay away, Fannie Mae is going to get buried in defaults.
But Lynch did what Lynch always does, his homework. He totally ignored the scary headlines, and he dug into the company's actual numbers. And what he found was this huge disconnect. While the fear on Wall Street was at an all-time high, the actual data on late payments was already getting better. The worst was actually over, but the market was still running for the hills.
And then came the ultimate test of conviction, Black Monday, the great stock market crash of 1987. In the panic, Fannie Mae's stock just got decimated. It was cut in half, from $16 all the way down to $8, even though the underlying business had never been stronger. But here's the absolute key. Right before that crash, Lynch had a chat with the CEO, David Maxwell, who confirmed that the big transformation had worked. He told Lynch that even if interest rates suddenly jumped a massive 3%, it would barely make a dent in their earnings. This was the turning point. The old fatal flaw, gone. The company was a completely different animal. So while everyone else was panicking, Lynch held on, more convinced than ever that he was right. So as the market started to climb back and the company kept putting up great numbers, Lynch's conviction just got stronger and stronger. It was time to go all in. Or, as they say on Wall Street, it was time to back up the truck. And that is exactly what he did. By 1989, the Texas problems were fading in the rearview mirror. That new mortgage security business was an absolute powerhouse. And yet, Wall Street was still skeptical. So Lynch just went for it. He bought as much of the stock as he possibly could until Fannie Mae was his single largest holding, hitting the fund's legal 5% limit. And just get a load of these numbers. The new business was a finely tuned machine. In 1989 alone, it packaged a staggering $225 billion worth of mortgages. I mean, that's bigger than the entire economy of some countries. And that fee business, which was just an idea a few years earlier, was now generating $400 million a year in pure, stable profit. And then the market finally woke up. As it so often happens, years of patience were rewarded in one explosive surge. The stock rocketed from $16 to $42 in just 1 year. It took a little dip during the Gulf War, but then it just resumed its relentless climb. The secret was finally out. What's really incredible, though, is that even after Peter Lynch left his fund, the story just kept getting better and better, and it leaves all of us with a powerful, timeless lesson for investing. So the lesson here is pretty clear, right? If you just ignored the screaming headlines about oil busts and real estate depressions, and instead you just focused on the simple story unfolding inside the company, you would have done incredibly well. You'd have known they had tightened their lending standards, that their average loan was small and safe, and that the reality on the ground was a world away from the panic you saw on TV.
And here's the real kicker. Even after this amazing run, all the way up to $69 a share in 1992, the stock was still a bargain. This incredible company, growing at 12 to 15% a year, was selling for a price-to-earnings ratio of 11. Meanwhile, the average slower-growing company in the market had a PE of 23. You were basically getting a Porsche for the price of a Ford. It was still on sale for half price.
So, what's the big takeaway here? The greatest investment opportunities often aren't in the flashiest new industry. They're found in great companies going through these huge changes that the market just doesn't get yet. Lynch's secret wasn't a crystal ball, it was just deep research and the courage of his conviction. And that leaves us with a challenge. What great business transformations are being ignored by the market right now? And more importantly, are you willing to do the homework to find them?
All right, today we are digging into a really powerful lesson from the one and only Peter Lynch, straight out of his book, Beating the Street. It's a fantastic story about a huge opportunity that even this legendary investor completely missed because, well, it was hiding in plain sight. So let's kick things off with a pretty wild confession from one of the greatest investors who ever lived. Peter Lynch, the guy who ran the legendary Magellan Fund, flat out admitted he totally overlooked a gold mine right under his own nose, the very industry he was the king of. It's just such a great reminder that even the absolute best can miss the obvious. Okay, here's our game plan. We're going to start with the treasure Lynch found in his own backyard. Then we'll break down his famous picks and shovels strategy. We'll see how a market crisis literally handed him an opportunity, how he pinpointed a single undervalued stock, and the secret edge he got from just doing his homework. And then we'll wrap it all up with the key lessons. You know, it's that classic can't see the forest for the trees situation, right? That's exactly what happened here. Lynch was running one of the biggest mutual funds in the world, but it never even occurred to him to invest in the companies that actually, well, that create and sell mutual funds. And just look at this list of names. I mean, these weren't just okay stocks, they were some of the absolute best performers on all of Wall Street. He was so focused on managing Fidelity's money, so busy finding the next hot stock to put into his fund, that he completely missed that the business of funds was an incredible investment itself. So this big miss, well, it actually led him to this brilliant investment philosophy. It's a strategy that completely shifts your focus. Instead of betting on the gold rush itself, you bet on the businesses that make the whole gold rush possible. This is the picks and shovels play. And this explains it perfectly. It gets its name from the California gold rush. Now think about it. Most of the folks who went out there hoping to find gold nuggets, they went broke. But the people who made steady, surefire fortunes were the ones selling the picks, the shovels, the tents, the blue jeans. They were profiting from the boom without having to take on all the risk of the hunt.
Applying that idea to Lynch's world is just fascinating. See, when you buy a mutual fund, you're basically the prospector. You're hoping your fund manager strikes gold. But if you buy stock in the mutual fund company, now you're the one selling the picks and shovels. You get to profit from the overall growth of investing, no matter which specific fund does the best.
So you might be thinking, okay, he missed the boat. But here's the thing about investing. The market is a very generous place, and Lynch's second chance came, as it so often does, directly from a crisis. Widespread panic created an absolutely incredible buying opportunity.
He actually got two shots at this. First, you had the big crash of 1987. Everybody panicked and dumped these stocks, thinking the whole industry was going down. It didn't. Then, a few years later, in late 1990, the Saddam sell-off during the Gulf War created another wave of fear and another chance to buy these fantastic companies for pennies on the dollar.
And just look at the payoff for anyone who was brave enough to buy during that panic. I mean, these numbers are just staggering. In 1 year, T. Rowe Price more than doubled. State Street Bank, up over 81%. Franklin, up 75%. This is your reward for being greedy when everyone else is scared.
Okay, so this brings us to the next level of Lynch's thinking. By early 1992, the cat was out of the bag. Everyone realized these companies were great, and their stock prices shot up. But Lynch wasn't about buying the entire industry. He was a detective, looking for that one forgotten, undervalued gem. And his attention turned to a company called Colonial Group. And this, right here, this is the question every single value investor has to ask themselves. When you see something that looks cheap, your first question isn't, is this a bargain? It's, why is this cheap? Is there a legitimate problem, or did the market just get it wrong? This table just lays it all out, plain as day. The market was basically saying, for every dollar T. Rowe Price or Franklin earns, we'll pay $20 for their stock. But for Colonial Group, it was only willing to pay $10. Its stock was valued at literally half the price of its peers. So Lynch starts digging, and what he finds, it's just incredible. The stock was trading for $17, the exact same price as when it went public 6 years earlier. But it was a way, way better company now. Earnings were up more than 50%, they were managing more money, they had zero debt, a pile of cash, and they were even buying their own stock back. The market was totally asleep at the wheel. And here's the kicker. This is just beautiful, simple math. The company had $4 per share in straight-up cash on hand. So if you take that away from the $17 stock price, you were really only paying $13 for the entire business. A stronger, more profitable business, which was less than its original IPO price. It was an absolute steal. But, being a great investor isn't just about finding numbers that look good on a spreadsheet. That tells you what is cheap, but it doesn't always tell you why. For that, you have to do a little old-fashioned detective work. This is classic Peter Lynch, his famous scuttlebutt method. And it wasn't complicated, right? No fancy algorithm. He just picked up the phone, he called the company's treasurer, and basically said, hey, what's the story here? Why have earnings been a bit flat? And from that one single phone call, he uncovers the secret sauce, the game changer, something that wasn't in any report. He found out that State Street Bank, a huge player, had secretly hired Colonial to market a whole new line of funds for them. This was a brand new, massive revenue stream that literally no one on Wall Street knew about yet.
All this talk about State Street Bank, it actually reminded Lynch of this hilarious story involving his mother-in-law. A few years before, she owned State Street stock. It had doubled, and he'd advised her to sell it, thinking it had run its course.
Well, the truth was, after she sold, the stock tripled again. But, and here's the funny part, the company did a 3-for-1 stock split. So the new share price looked pretty close to the price she sold at. She never put two and two together, and to this day, she still congratulates him on his savvy call to sell at the top. It's just a great lesson in humility.
All right, so let's pull all of this together. Let's take this whole incredible story, from missing the obvious to finding a bargain during a panic to doing the extra homework, and let's boil it down into a simple playbook you can actually use.
Here it is, step by step. First, look in your own backyard. Start with what you know. Second, always ask, who's selling the picks and shovels? Who profits from the trend itself? Third, learn to love fear. Market panic is your best friend. Fourth, be a detective. Find that one forgotten stock in a hot industry. And finally, number 5, do your homework. That one extra phone call can be your secret weapon.
And that's really the question I want to leave you with. This strategy is absolutely timeless. It doesn't matter if we're talking about AI, electric vehicles, cloud computing, whatever the next big thing is. The question is always the same. Who is selling the picks and shovels? If you start looking at the world that way, you'll start seeing these incredible opportunities all around you.
All right, welcome to our explainer. Today, we are diving into one of investing legend Peter Lynch's most brilliant and, most relatable ideas, how the places we eat at every single day could be holding the secret to some incredible wealth.
I mean, think about that for a second. Could that place you grab a burger or your morning coffee be more than just a meal? Could it actually be a life-changing investment? It sounds almost too simple, doesn't it? But the truth is, by just paying attention to the restaurants you see getting busier, getting cleaner, getting better, you could have spotted some of the biggest winners in stock market history way before Wall Street had a clue.
Let's just start with a number that's, it's almost hard to believe. 400 times your investment. That's what happened for the early investors in McDonald's. This wasn't just a good stock pick. This was the kind of thing that builds fortunes. In Peter Lynch's world, a win like that gets a special name. He'd call it a 400-bagger. And understanding that term is really key to this whole thing.
So what in the world is a bagger? Well, it's actually a beautifully simple idea. It's just a way to count how many times you've multiplied your original money. A 2-bagger, you've doubled it. A 10-bagger, which, believe me, is the home run most investors dream of, means you've made 10 times your money. So when we're talking about a 400-bagger, well, you start to get a sense of the sheer world-changing power we're dealing with.
Okay, so here's our game plan for today. First, we're going to unpack that core idea of investing where you eat.
Then, we'll take a trip back in time to the first fast food fortunes. After that, we'll see exactly why slow and steady growth is the secret sauce. Then we'll get practical with an investor's checklist, and finally, we'll talk about how you can find the next big winner. So let's start with this fundamental principle. Professional investors, they're surrounded by all this complex data and financial models, and they often develop a huge blind spot. They just can't see the simple, powerful things happening right out there on Main Street.
Back in the 60s and 70s, the so-called smart money was all about the big, sexy tech stocks of the era. They called them the Nifty 50. Those were seen as the only game in town. The idea that a humble business selling donuts or fried chicken could deliver serious money, they would have laughed you out of the room. And that one single arrogant assumption ended up being one of the biggest missed opportunities in financial history.
And this is exactly where you, the individual investor, have a massive advantage. You're on the ground. You see the coffee shop that has a line out the door every single morning. You're the one who notices when that local favorite is always clean, well-run, and then suddenly opens a second spot and then a third. This local knowledge is your secret weapon. It's a real-world research tool that no analyst in a skyscraper can ever hope to match.
Now, this isn't just some nice theory. The proof is in the pudding, or I guess in this case, it's in the burgers and fries. The whole idea of investing in restaurant chains absolutely took off in the 1960s and 70s, and it made fortunes for regular people who were just paying attention to where their friends and neighbors were going out to eat.
And the opportunity wasn't just a one-time thing. It was like this wave that kept rolling in. It started with places like Howard Johnson back in '61. Then you had Bob Evans and Kentucky Fried Chicken go public, and then, boom, the Titans arrived, McDonald's and Shoney's. But even if you missed that entire decade, the 70s came along and gave you another shot with brands we all know today like Taco Bell and Wendy's.
Now I want you to really look at the scale of these returns. We keep talking about the McDonald's 400 bagger, which is just incredible, but look at the others. Shoney's gave you 168 times your money. Bob Evans Farms, an 83 bagger. These were not just good investments. These were absolutely legendary, wealth-creating machines for anyone who got in early.
And the stories behind these companies are often just as amazing as the numbers. I mean, take KFC. It wasn't dreamed up in some corporate boardroom. It was the last-ditch effort of a 66-year-old man, Colonel Sanders, whose business was about to be wiped out by a new highway. Facing total ruin, he packed up his secret chicken recipe and hit the road. It's just a powerful reminder that the next great investment can come from the most unlikely places.
And here's a really important point. These opportunities often give you a second chance. There was a brutal market crash in the early 70s that hammered all stocks, the good and the bad. A fantastic growing company like Taco Bell saw its stock get crushed all the way down to $1 a share. But for investors who knew the business was still strong, who saw people were still lining up for tacos, it was the chance of a lifetime to buy in at a massive discount before that stock soared to $40.
But of course, not every restaurant with a cool concept becomes a home run. A lot of them fail, and they fail spectacularly. So how do you tell the winners from the losers? Well, this next story, a tale of two very similar burger chains, holds the answer.
All right, let's look at Chili's and Fuddruckers. Both started in Texas, both sold these popular gourmet-style burgers, but one of them became a household name, and the other became a cautionary tale. The difference? It all came down to the pace of their growth. Fuddruckers got greedy. They just exploded, trying to open over 100 new restaurants in a year. That rush meant bad locations, staff who weren't trained properly, and sloppy food. They just burned out. Chili's, on the other hand, was the tortoise. Slow, steady, methodical growth. 30 to 35 carefully chosen spots per year. And they built an empire that lasts.
So the huge lesson here boils down to this one incredibly useful rule of thumb. When you see a popular restaurant chain shouting about its plans to open more than 100 new locations in a single year, that's not a sign of strength. That is a massive red flag. That is the danger zone. Controlled, disciplined growth is almost always the secret to winning in the long run.
Okay, so we've heard the stories, we've seen the warnings. Now let's turn all of this into a practical toolkit. Here's a simple checklist straight from Peter Lynch's playbook that you can use to size up a promising restaurant stock.
You really only need to track 3 critical things. Number 1 are sales at the existing stores, the ones that have been open for a while. Still going up? This is called same-store sales, and it tells you if people still love the place. Second, is the growth rate manageable? We just saw why that 100-unit-a-year rule is so important. And third, does the company have a ton of debt? A business with low debt is tough. It can survive lean years. A business drowning in debt can fall apart at the first sign of trouble.
So here's how you put it all together. It's a simple process. Step 1 is what we've been saying all along. Use your eyes. Be an observer in your own town. Step 2 is a quick check. For a single restaurant location to be a good investment, its yearly sales should at least equal what it costs to build and open it. And step 3 is just to track those 3 key numbers we just talked about. See? It's a straightforward process that anyone can get the hang of.
Okay, this is all fascinating history. I get it. But you're probably asking, how does this apply to me right now? Can we still use these lessons to find the winners of today and tomorrow? And the answer is a resounding yes.
Take a look at this list. This isn't from the 60s or 70s. This is from 1991. These were the top restaurant picks from a major investment firm. And if you'd bought this basket of stocks, you would have doubled your money in a single year. This just proves that monster winners like Cracker Barrel and Outback Steakhouse kept coming along long after that first fast food gold rush was over.
And Peter Lynch himself, he kept practicing exactly what he preached. He found one of his own big winners, Aubon Pain, not by reading some dusty industry report, but by going to his local shopping mall. He saw this brilliant idea, a fancy French bakery with the speed and efficiency that Americans love, and he just knew it was going to be a winner.
You know, this quote just perfectly captures the entire philosophy, doesn't it? Why stress out over some complicated technology you can't possibly understand when there are fantastic, simple, profitable businesses right there in front of your face? A great bagel sold by a well-run company can be a much, much better investment than some confusing microchip.
So what's the ultimate takeaway from all this? It's that this opportunity never really goes away. As long as people love to eat out, new concepts will emerge, new chains will start to grow, and some of them, a precious few, will become incredible 20-baggers, maybe even more. And the person who's in the best position to spot them first isn't some Wall Street analyst. It's an observant diner. It's someone just like you.
So I'll leave you with a challenge. The next time you go out, really pay attention. What new place has a line out the door every night? What small local chain seems to be popping up in the next town over? The next great restaurant stock could be your favorite lunch spot right now, and it's just waiting for you to notice.
Welcome to The Explainer. Today we're going to get into the head of a true legend, investor Peter Lynch, and unlock one of his most important lessons: how to actually check in on your investments. You know, so many of us hear that you should just buy a great stock and then forget about it. Well, according to Lynch, that is one of the fastest ways to lose your shirt. He came up with a really simple but powerful routine to keep your portfolio healthy, and today we are breaking it down step by step.
Right off the bat, Lynch hits us with this powerful warning, and it really cuts against the myth that's super popular in investing. I mean, the whole idea of buy and forget, it sounds so easy, right? It sounds relaxing. But what Lynch is telling us here is that in the real world, that kind of passivity, it isn't just unproductive, it's actively dangerous. Because things change, companies change, and if you're treating your portfolio like some set-it-and-forget-it kitchen appliance, you are setting yourself up for some serious trouble.
And listen, he's not just talking about some risky little startup companies here. This applies to the absolute titans of industry. I mean, just think about it. For decades, companies like IBM, Sears, and Kodak, they were the bluest of the blue chips. They felt absolutely unshakable. You could have bought their stock, tossed the certificates in a safe deposit box, and slept like a baby. But the world moved on. Their businesses failed to adapt, and all those investors who weren't paying attention watched their can't-miss investments get hammered. This right here is exactly why you have to stay engaged.
So here's our game plan for today. First, we're going to really pick apart that dangerous buy and forget myth. Then, we'll get into Lynch's brilliant and simple solution, the 6-month checkup. After that, we'll see it in action, how he actually applied it to his own stocks. We'll also learn how to spot the red flags when a company's story starts to go south, and we'll wrap it all up with his timeless golden rules that every investor should know.
Okay, let's dive into that really tempting but dangerous assumption that you can just buy a good stock and not look at it for years. See, the real problem with that is it confuses owning a stock with owning a piece of a business. A real business has to fight, it has to compete, it has to innovate every single day. And as an owner, which is exactly what you are when you buy a share, you have to stay plugged in.
So this is the big question, right? If you're not supposed to just obsess over the daily stock price, what are you looking for? Here's the key. The price only tells you where the stock has been. Lynch wants you to focus on where it's going. He wants to know the story behind the price. Is the business getting stronger? Are they hitting their goals? Think of it this way. The stock price is just the symptom. The company's story, that's the real health of the patient.
All right, so what's the antidote to this buy and forget problem? Well, Lynch laid out a simple, powerful routine he called the 6-month checkup. Now, this is not about day trading. It's not about being glued to your phone all day. It's about having a regular, repeatable process to check in on the businesses you own, just like a real business owner would. It's kind of like a scheduled physical for your investments.
And this is a disciplined thing, you know? It's not just a quick glance at your statement. Every 6 months you sit down, you read the latest company reports, and you try to get a feel for how things are going. Your whole goal is to revisit why you bought the stock in the first place, and you do that by asking 2 really fundamental questions.
And here they are. These are the 2 pillars of the whole checkup. The first one is all about the price tag. You're asking, hey, based on how much money this company is making, am I still getting a good deal? You look at its PE ratio, its price to earnings. The second question, though, that's about the story. What is actually happening inside the company that's driving those earnings? Are they opening new stores? Is that new product flying off the shelves? That's the narrative that's really going to move the needle in the future.
So, after you've asked those 2 big questions, your work is going to lead you to one of 3 pretty simple conclusions. First, if the company's story has actually improved and the price is still reasonable, hey, maybe it's time to buy more. Second, if the fundamentals are starting to stink, well, that's a pretty clear signal to think about selling. And third, if the story is basically the same, no better, no worse, you can just hold on. Or maybe you found a better story somewhere else. It's that simple.
Okay, theory is one thing, but seeing this in the real world is where it all clicks. So let's do something cool. Let's look over Peter Lynch's shoulder as he actually does one of his 6-month checkups on a few companies he owned way back in 1992. This is where it all comes to life.
All right, first up, the body shop. Now, the stock price was down, which to most people is a bad sign, right? But on top of that, it was getting some of the weirdest negative press you could imagine. A tribal chieftain who supplied the company with Brazil nuts for their hair conditioner was arrested for, get this, allegedly raping a nanny in London. I mean, you can't make this stuff up. Most investors would run for the hills. But Lynch, he saw that price drop as a potential opportunity, and he dug in.
And this quote, this gets right to the heart of how Lynch thinks. He just completely tuned out all the bizarre headlines and focused on the numbers, the fundamentals. That drop in the stock price brought its PE ratio down to about 20. Now, for a company that was still growing its profits at 25% a year, to him that was a screaming bargain. It's a perfect example of thinking like a business owner, not like a panicky headline chaser.
And just to put that into perspective for you, at that time, the average stock was also selling for about 20 times its earnings, but it was only growing at, say, 8 to 10%. So at the Body Shop, you could pay the exact same multiple for a business that was growing almost 3 times as fast. His checkup showed him that despite all that crazy noise, the story was not only still good, it had actually become an even better deal.
Now here's a really interesting one because it shows how this checkup process can lead you down some unexpected paths. So Lynch was reviewing a stock he owned called Sunbelt Nursery. But while he was doing his homework on them, he noticed that their main competitor, Callaway's Nursery, a company he thought was the best in the entire industry, had also seen its stock get totally crushed, falling by half. All of a sudden, a new and better option was on the table.
And there's the big lesson here. Sometimes your checkup on one company reveals that the best move is actually with its competitor. See, Sunbelt was still a good company, but now Callaway's, the class of the industry, was also on the discount rack. He decided he liked their story just a little bit more. So the checkup gave him a chance to upgrade his portfolio, swapping a good company for a great one at a great price.
So we've talked about when the story gets better, but what about when it gets worse? This is just as critical, maybe even more so. A huge part of the checkup is about spotting those red flags, either ones you missed the first time or new problems that completely change the game. This is how you protect yourself from those catastrophic losses.
Lynch has this great analogy for this. He says investing is like a poker game, except you get to see more cards as time goes on. The 6 months checkup is your chance to look at the new cards that have just been flipped over. So let's look at what happened with a company called Supercuts, where his checkup revealed not one, but 2 really lousy cards that change his whole hand.
And these are exactly the kind of bombshells you're looking for. Card number 1, the guy who is the expert on their whole franchise and growth strategy, he just up and left the company. That's a massive blow to the story. And card number 2, and this is a sneaky detail he'd missed before, he discovered that a bankrupt firm owned a huge block of 2.2 million shares. Now what does that mean? It means all that stock was eventually going to get dumped on the market, creating massive pressure pushing the price down. These are the lousy cards the checkup is designed to uncover.
So let's just do a quick recap of how this process led to totally different actions. For the Body Shop, the story was great and the price got cheaper, so that was a buy more. For Phelps Dodge, a cyclical stock, it had already shot up 50%, so the easy money was probably made. For General Host, the nursery company, the story was a little weaker, but it was still pumping out cash, so that was a hold. And for Supercuts, those new lousy cards made the story way worse, so it was time to reevaluate everything. You see? Every single decision was driven by the story, not just the stock price.
Now that we've seen the process, we can kind of zoom out and look at the philosophy behind it all. So to wrap things up, let's go through a few of Lynch's most famous golden rules. These are the principles that really reinforce everything we've talked about today, the things that should guide every single one of your investment decisions.
You see the theme running through all of these, right? It's simple. Do your homework. Be an investigator, not just a gambler. You have to actually understand the business you're buying. You have to know the story of why you own it. And this is the big one, you have to have the emotional fortitude to see a market meltdown not as a disaster, but as a Black Friday sale. That single shift in mindset is what separates the winners from the losers.
And this really brings us to the final and maybe the most important takeaway of all. Investing isn't about being a genius. It's about having discipline and doing a little bit of research. Your temperament, what Lynch calls your stomach, is so much more important than your IQ. You sell because the business is in trouble, not because the market is having a panic attack. And if you're not willing to study the companies, well, like he says, you might as well be playing poker and betting big without ever even looking at your own cards.
And that, right there, is the power of this incredibly simple habit. Just a 6-month cycle. It's what transforms you from being a passive gambler into an active, informed business owner who is actually in control of your own destiny.
So I want to leave you with this one question. Think about your own investments right now. Seriously, which company's story have you totally neglected? Which stock did you buy on some hot tip and then just let it ride without a second thought? You have the framework now. It's time to find out if that story has gotten better, worse, or stayed the same. It's time to go check your cards